It is Friday, December 30th, New Year's Eve here in New York City. This is Yahoo Finance Live. I'm Brad Smith alongside Brian Sazi. Julie Hyman has the day off. It is the final trading day of the year. Let's get right to the top things that you need to know as the clock hits 9 a.m. Futures this morning, yeah, they're down across the board as we wrap up what has been a brutal year for the stock market. And as investors close the book on 2022, they remain focused on inflation, gas prices, and now how China's reopening may impact the economy. We're going to dive into all that and what to expect in the new year coming up.
And while central banks have taken a more dovish tone in the recent policy adjustments, the Fed and ECB are still hawkish. But what does that mean for a global recession? We'll get into the Fed's outlook for 2023 in just a moment.
And was the collapse of FTX the end of the cryptocurrency era? Well, that's a big question, but one analyst says crypto is dead. That's one analyst. We're going to have them on later, and that's thanks to Sam Bankman-Fried. Mizuho's Dan Dolev is going to join the show to break down the future of Bitcoin.
All right, but most importantly, we kick off today, rounding out 2022 and looking back at how some of the market's biggest names performed during this roller coaster year. Let's get over to our markets master, Jared Blickery at the Wi-Fi Interactive. Jared, I think a lot of investors are just saying, you know what, I'm done with this year. I'm over it. Let's flip that calendar.
Give me 5 minutes here. Give you guys 3 hours, okay? This is the Nasdaq 100 year to date, and this is brutal. We have seen this. We've been seeing this evolve from day to day throughout the year. You're going to notice a lot more dark red than dark green. Obvious what the dark green means. Those are the few stocks that are ending the year with positive performance. And let's take a look here. There's actually more than 100 stocks here because we had a recent change out, and I included some of the stocks that have now been omitted from the index, and I'll get to those in a second. But just want to show you, Pinduoduo is the number one stock here in the Nasdaq 100. It's up 41%. Now, we're going to talk about some more Chinese stocks in a second here, but then you got Vertex, we got FANG. Diamondback Energy is a new addition. That, along with Baker Hughes, was added. So now the Nasdaq 100 has a little bit more energy exposure. So that's going to help it if we have more energy, energy surging in the new year. But then you take a look at some of the losers. I mean, everything on the bottom line here is down 60% or more. This is just about unprecedented that I've seen, at least going back to the global financial crisis, maybe those pandemic lows back in the day. But check out DocuSign. This was actually deleted earlier in the month. I just have it here for illustration purposes. It's down 63% in the lower left here, followed by Meta, Zscaler. That's down 65%. Tesla, a stock that big, along with Meta on the bottom row, not a good sign. Atlassian, a lot of software names here. Match Group was deleted. That's down 69%. Peloton still in the index. That's down 77%. Lucid, the number one stock, trading to the downside here, down 82%. They kept that in the index. And interestingly, they added Rivian. And this is interesting to me because this stock is down 82%, and yet they added it to the index. Usually that doesn't happen. So we'll just have to see what comes in the new year. And I'll tell you what, guys, I think, as you said, it would be a welcome relief just to kind of close the books on this year.
Okay, so Jared, while we have you, what are you also seeing out of China as well? Because the country right now, we do know, is pivoting away from its zero COVID policy. So what are we seeing there?
Yeah, well, first of all, I wanted to talk about the currency markets, and then I'll talk about some of the stocks. So the Chinese yuan, the U.S. dollar versus yuan, actually hit a new low. And let me just find the CHF. We go. That's actually, there we go. CNY equals X is our ticker. And here is US dollar versus the Chinese yuan year to date. You can see still up 8.5%, but off of those highs there. Critically, the yuan has been appreciating as they have been reopening here thanks to COVID. Now, here's what happens. So the dollar has weakened over the prior month by about 3.5%. Doesn't seem like a big move, but it actually is in currency terms. So that's good to see there potentially on that front. And let me just get to those Chinese stocks in the Golden Dragon Index. A lot of these names, so a very bifurcated board. So let me just sort this by performance so you can see the distributions of the greens and the reds. A lot more reds. And you take a look at the bottom row here, a lot worse than the Nasdaq 100. But depending upon which of these tickers you're looking at here, I'm going to go back to a market cap view. Some of these stocks bottomed earlier in the year, and some of them have lifted off towards the end. Here's a year-to-date look at Alibaba. Still one of the biggest, but you can see still camping out in the bottom end of its range here, probably the bottom 1/3, down 25%. This stock only bottomed 1 month ago. You contrast that with one of the winners here. This is a Nasdaq 100 winner by the year. Pinduoduo up 41%. You can see it bottomed in March. So China kind of its own asset class this year. That's what I've been saying. Trade it at your own risk because we don't know what's going to happen in the new year with respect to that PBOC and also President Xi.
Yeah, and for some of those companies, especially given what we had seen in the annual New Year letter from Huawei this year, it'll be interesting to see how many of those companies are now baking in a business as usual or a new normal to some of those year-over-year comps that they're now tracking towards as well. Yahoo Finance's own Jared Blickery breaking down all things China for us, as well as general markets over the course of this year. Thanks so much. And sticking on the topic of China, as they begin to reopen and ease COVID restriction, cases, however, have already begun skyrocketing. Yahoo Finance's Anjali Kamlani is tracking this story. Joining us now for the latest. Anjali, what do we know so far?
Well, we do know that we don't know the cases right now. That's actually the problem. So China has stopped reporting publicly the growth in cases. We do know that they've seen extremely high numbers the prior week. So baking that into the outlook, Airfinity has come out with a new estimation that they are now seeing 9,000 daily deaths rather than previously saying 5,000 was the estimate. So that just tells you the whole picture of what China is going through right now. So looking at that broad picture, increasing cases, pulling back on the zero COVID policy, not having that insight. So now we've seen, of course, the different countries that have now put in place rules, testing to see, what is coming over from China, just to be able to track it on our side, our being the rest of the world. Italy, saw half a plane full of cases the other day. So it really is a concerning picture. And we're seeing that, different countries are choosing whether or not to restrict certain airports, like in the case of Japan. Italy is pleading with its neighbors to also implement, new rules for testing. The UK has said it has no intention to right now. So it's really a mixed bag right now in the reaction to this growth of cases in China. And some countries are even, calculating what it would take to continue this testing, the cost of it. Over here in the US, we also are looking at how to continue to fight COVID and the dollars needed. You've heard all the public health officials plead with Congress to continue funding. In a recent note, based on the passing of the bipartisan funding bill, Health Secretary Javier Becerra said, quote, "As COVID-19 evolves, we must evolve with it, and without additional funding from Congress, we'll be limited in our ability to develop new vaccines and treatments, increase vaccine uptake, and send out another round of tests." So even for us at home, it's going to be a really interesting picture.
The problem here, I would say, Anjali, from a China perspective, is they are willing to let this rage. They seem to be at that point where they're willing to let the whole crisis reemerge and just rip across their country and be down with everybody else.
I would also counter that the rest of the world is accused of doing the same, right? Like, we also have pulled back on measures. Where are their masking measures? Where are their rules of testing? And some doctors have even pointed that out. What is the point of having that testing at the airports if the rest of the country, there are no mitigation measures going on to stop that from spreading further? But so it seems, pretty interesting from that perspective.
It's going to be an interesting few months. Oh, go ahead, bro.
Yeah, there's also some advancements out of Merck that we just wanted to also get to this morning, too. What do we know about what's coming from the massive amount of research and development that's moved forward over the course of the year in biotech and biopharma companies? But for Merck right now, what are they saying? So
Merck has had their molnupiravir, which is their drug to treat early onset of the disease. So for certain individuals, that has been approved in China. That's the first, outside treatment really that they've been using. It's interesting that Merck got that, because we know that over here, on our soil, it wasn't necessarily the preferred drug of use. Paxlovid has really been that preferred drug of use to treat COVID. So interesting that they got the green light over there in China, and it's good, and obviously good for them. We know that there has also been some concern about the effectiveness of the Chinese vaccines. So there's also some concern there. No access to outside vaccines except for foreign nationals in some instances. I think it's Germany specifically. So really, again, just a lot when it comes to not knowing, what the tools are. They're definitely facing a shortage there of medications right now, as you've seen the hospitals. So really concerning picture over there.
Anjali Kamlani, thanks so much. Appreciate it. All right, what a year it has been for crypto in a not so good way. Bitcoin and Ethereum both down over 65% year to date, with little help from the likes of FTX's Sam Bankman-Fried. While crypto-based companies such as Robinhood and Coinbase find themselves down big as well on the year, even the crypto bulls had a rough year. Michael Saylor's MicroStrategy has continued to buy Bitcoin despite the turmoil. Company shares are down about 70% on the year. And lost in all of this FTX stuff, Brad, is that we started this year, and I'm on Yahoo Finance on our crypto page right now. Bitcoin started at the year $47,000, let's just say, a little over that. It's now a little over $16,000. Bitcoin has not moved anywhere really since the middle of June. And you have to think, well, what gets that price action moving back up again? And to me, it's wildly unclear.
It is, and you would need to see a lot more certainty enter into the equation. Where that certainty comes from, it could be a range of areas. I think the most noted would be any type of regulation that moves forward from here. And there's a larger question of if the regulatory framework that has been drafted, even to this point from the Gillibrand-Lomas bill, if that will even still be used because of the fact that you did have the fingerprints of Sam Bankman-Fried within that and baking in some of his own thoughts and expectations. And anytime you do have someone who is as much a staple or at least a figurehead or was a figurehead within crypto for as long as Sam Bankman-Fried had been, for some of the noted bailouts at the time that he was moving forward with for some of the either crypto companies like a BlockFi or some of the trading platforms, and just trying to buy stake to shore up their stock and equity price. All of that considered, it's going to show that there is not one singular person that should be the overseer of how well or how badly crypto does. If anything, it's really the consortium of different efforts that need to win out at the end of the day. And I think that's what end users or owners and custodians of their own crypto, that's what they're looking for, some type of confidence in that they can have custody, that they don't have to be vulnerable to either hacks on certain platforms where they have no ability to kind of safeguard against those own hacks outside of just putting it in cold storage. And utilization is another measure. So regulation, utilization, those are two things. But then additionally, we just need to see more good actors in crypto right now, quite frankly. And I think that's where there can be a little bit of the movement forward, but I don't think that comes until after we see some swift regulatory, not swift at this point, but after we see some concerted regulatory action.
Yeah, and this was supposed to be the year, Brad, where all the institutions were going to get into crypto and everybody's going to be crypto trading, BlackRock maybe.
Super Bowl ads.
Right, Super Bowl ads. You had a really good article by over in Barron's. I believe it hit earlier this morning, looking at Fidelity's efforts. Middle of this year, I believe they hired a bunch of folks to lead their crypto efforts. Where are they now? You don't hear anybody talking about it. And at least that article in Barron's, I think, downplaying what Fidelity may or may not do moving forward in crypto. But again, you're not really seeing the institutional space make a big push in here, and rightfully so.
Just lastly on this, I'll add, because in this crypto winter, there's been a major crackage of the ice, if you will, and there have been a few things to fall deeply into the depths of whatever that frozen ocean may look like. And it really is a few things. Algorithmic stablecoins, I think the trust in those has absolutely eroded, number one. Number
so don't
two,
buy Bradcoin.
Do not buy Bradcoin, do not buy Bcoin, do not buy, look, I mean, not recommendations, of course, but
there is no Bradcoin. Please don't go on our site, search for Bradcoin.
There was a Slapcoin though for after Will Smith slapped. Yeah. Anyway, neither here nor there. But in this other ice crack here, it's the NFTs, it's the non-fungible tokens, and there is a way forward for the technology to exist, but it's just a matter of how we're ascribing or attributing value to so many of the things that have been tokenized as well. So I don't expect to buy a squiggly line for $75 million in the future, but
maybe for $20 million, right?
You know, it's going to come down.
Sell.
Guys, coming up, why our next guest says it's still not the time to broadly buy equities. We're going to discuss next. They're definitely not buying the squiggly line. Addressing the market expectations mismatch here. It's a tighter than expected labor force, likely to lead continued Fed hawkishness and may clash with investor expectations of a Fed pivot soon. So joining us with how this will affect the outlook for markets heading into 2023, we've got Scott Wren, who's the senior global market strategist over at Wells Fargo. Scott, great to have you here with us, and an early Happy New Year to you as well. I mean, we've discussed at length going into 2023 what some of the expectations are, but what are some of the key indicators that you would be keeping a close eye on even as the new year strikes and as we start to hear more inclination about what the Fed's policy pathway will be?
New Year as well. I think some of the things that you want to pay attention to, we know the Fed's watching the labor market, so you want to not watch initial jobless claims. That number is going to climb, at least in our opinion, and certainly the Fed wants it to climb. They want a weaker labor market. We think we'll see about 5.2% unemployment by the end of this next year. And then another thing I think you want to watch are earnings estimates. And in our opinion, we have a $205 number out there for next year for the S&P 500. I haven't looked at the consensus in a while, but I think it's probably around 230, 235, something like that. So in our opinion, these earnings estimates are going to come down. We expect a moderate recession to start, pretty soon after the new year and maybe last mid-year, June, July, August, something like that. So I think as far as the key indicators, you want to watch earnings, you want to watch the labor market. The labor market's going to tell you what the Fed's going to do.
Scott, boldest predictions for stocks next year?
We think we're going to see 4,400. That's a 15% return from where we are right now, excluding dividends. So overall, we think the second half is going to be pretty good. The Fed's probably has some rate cuts in its pocket in the second half of the year, which I think is I'm not sure if that's totally non-consensus, but we're expecting about 75 basis points worth of cuts. And so we're expecting a strong second half, and we want people to take advantage of the volatility, probable downside volatility that we're going to see here in the early month, 2, 3 of the new year.
Scott, let me follow on that. How many rate cuts do you see in the cards next year?
We have 3 25 basis point cuts penciled in the second half of the year.
Okay. Also, S&P 500 expectations. FactSet certainly right now has been holding on to 5.5%. Do you believe that we need to see some earnings guidance start to come down?
I think we will. And, the problem with individual company analysts is that, now in this day and age, they wait for the company to tell them what to do with their earnings number. Because believe me, if you're an individual company analyst, you call the CFO, you want to talk to him, and your earnings estimate is out of range, he's probably not going to answer your call. So individual company analysts tend to kind of stay in line with where the company wants them if they want to have any communication with that company. So I think you're going to see some earnings estimates from the companies themselves start to come down, guidance come down, and that's when you're going to see the individual company analysts come down. You cannot wait for that. You have to anticipate whether that's going to happen or not, and we're anticipating that it will happen.
Do you see earnings declining next year?
We do, not by a lot. We've got, we think we'll come in at about 215 this year in the S&P 500. We've got the number next year, as I mentioned, at 205. So, 4 or 5% earnings decline. Not a lot, less than what you'd see in a normal average type of recession, but a contraction nonetheless.
Okay, what are the sectors that you would be tracking and are tracking right now? Has there been any rotation in your own strategy, perhaps even in the final moments of 2022 going into 2023?
Well, I'll tell you, this is what we've been doing really March, April. We made some moves. We've been a lot more defensive, a lot less cyclical, a lot less sensitive to the ebb and flow of the economy in these portfolios. And so, we've liked things like healthcare, and we've downgraded small cap, emerging markets, consumer discretionary, industrials, things that are sensitive to the economy. We're not looking to get more defensive. The conversations we're having at an investment strategy committee level are, when do we get more assertive? What's the timing on that? Normally the market bottoms out and starts to turn higher about halfway through a recession. So things like small caps and consumer discretionary and industrials and financials and high yield bonds, they start to do better. Those are all early cycle outperformers. So for us, we're trying to figure out, when do we go from defensive to something more cyclical where portfolios will benefit from the recovery that we anticipate as we move through the second half of the year and into and through 2024.
Scott Wren, Senior Global Market Strategist at Wells Fargo. Good to see you. Have a happy New Year. We'll talk to you soon.
Happy New Year, guys. Thank you.
Coming up, Beyond Meat is boosting its McDonald's offerings. More on that and the opening bell next. We're seeing Beyond Meat shares down slightly in the pre-market. Welcome back. Let's take a look at some hot Yahoo Finance tickers on this Friday before New Year's Eve, starting with Beyond Meat, the plant-based meat company in focus this morning after announcing a new menu offering at McDonald's in the UK and Ireland called the Double McPlant. Yes, the Double McPlant, which will be unveiled January 4th. And it's been a tough year for Beyond Meat. The losses have piled up, but this is a nice, I would say, win for them to end this year. I know there's been a point of focus by Beyond Meat founder and CEO Ethan Brown to get more offerings inside of McDonald's. He's been at this for so many years trying to make this happen. So hat tip to him for getting that done at least. Double McPlant. Social media seems to be excited about it. But again, you know, a challenging year for this company. It will be interesting to see how they come out of the gate in the first half of next year and if they could start getting things back on track.
Yeah, more plant patty, less fatty. I mean, at the end of the day, it's two lines of businesses that Beyond Meat has. It's the refrigerator and the retail side that they're trying to get into, and then there's the restaurant side. And the restaurant side really accounts for, or at least prior to the pandemic, accounted for so much of their growth prior to everyone needing to hunker down and fill up the freezer, fill up the refrigerator, perhaps get some new alternative meats within there as well for their diet. And I think that's where Beyond Meat really had to shift their strategy, thrust forward some of the capital spend in terms of its own operations, so they weren't leasing out space, but instead owning the space that they were manufacturing in. And that pulls forward a lot of the capital expenditure and the costs associated. And so now with that new facility that they do have, it's about, okay, where can we continue to drum up some of, on the pilot basis where we've already had certain partners, more long-term partnerships to have our plant patty on the menu.
What was that? Double patty, less fatty?
That's
Really good. No, but they have gained a lot of distribution that I would argue is not reflected in Beyond Meat stock. I picked up a package of frozen Beyond Meat meatballs at CVS last night for dinner.
Oh, yeah?
I was surprised to see them at CVS, and then I went back and remembered, oh yes, they signed a distribution agreement with the company. That was the only meat product available at my local CVS, and I ate the whole package again.
Have you compared them side by side, like Beyond Meat versus Impossible Foods?
I'm a Beyond guy,
Yeah?
through and through. Okay. That's just how I live.
But it's more expensive. So, and that's the other thing,
$8, trust me, $8 for my meatballs.
Right. So that's the more expensive option that's going to be on the menu
Well, I'm bougie.
for a lot of customers.
I'm bougie. $8 for meatballs. I'm good.
Well, Brad and non-bougie over here is going to be walking into McDonald's looking for a value menu when the recession hits,
Yeah.
and I'm going to be saying, okay, let me get the dollar fries, or let me get this value package. And is the McPlant, the double McPlant, excuse me, going to be on that?
But you're getting a double patty. That's less fatty, Brad. You said it, not me. You're figuring this stuff out, man. I didn't say that. Look at it. That looks delicious. I'd pay a little more for that. That looks great.
The real question is whether or not it'll make it to the metaverse at some point, like Chipotle has made it into. We're also watching shares of Meta today after the tech giant has faced a tumultuous year. It's down over 60% year to date, joining several members of the battered tech sector. You know, when Jared was running through some of the names off of the top that have seen dismal years, I don't know if we have a year-to-date chart of Meta platforms that we could toss up to really take a look at some of the movement. And a few things that this has come back to. Number one, and most recently perhaps, is the deceleration in advertising dollars that are going digital. Now, there's still, of course, a large market for digital advertising, obviously, but it really comes back to how much of those spends in cost restructurings for some of the biggest advertisers and agencies that are managing ad spends are pulling back from their spends on Facebook Blue or even on Instagram, one of the more popular platforms with a younger demographic. As at the same time, Meta Platforms itself earlier this year had announced that they're going to be spending $10 billion in essence, round number, for making the metaverse real.
Far be it for me to justify anything Meta does, but I do think what Mark Mahaney over at Evercore ISI told us yesterday pointed out something very interesting that all investors need to consider. Meta has been arguably out in front of Google and Amazon in cutting billions in dollars of costs. And you have to wonder what quarter do those cost cuts start to appear for Meta? Is it the first quarter or second quarter? Because you could be looking at, even if sales are still under pressure because of what's happening in the economy, you could be looking at a major reacceleration profits for this company, while a competitor like a Google, while a competitor like an Amazon, at least in terms of investment dollars, they're still probably only announcing cost cuts in the middle of next year.
Interesting. You know, as we take a look at some of the big tech or mega cap tech names there on the screen, and we were talking about Meta's decline here over the course of the year. Some of the other worst decliners that I saw when Jared had them up on the heat map earlier, Lucid, Rivian, Okta, Peloton, all of these were some of the Peloton plays, or excuse me, the pandemic plays. Peloton was a pandemic play, and Meta certainly was a beneficiary of the amount of screen time growth that we had seen over the course of the pandemic too.
Bottom line is, Lucid needs to make some cars. Rivian needs to make some cars and get out on a more consistent production schedule. That's one reason why those stocks have tanked. There we have that opening bell on Wall Street on this final trading day of what has been a very challenging 2022. There's Chris Rondo, friend of Yahoo Finance, ringing that opening bell. Good for Chris. He has come a long way. He's been the longtime CEO of Planet Fitness. Of course, they're the now longtime sponsor of the New Year's Eve festivities down in Times Square. Good to see Planet Fitness, a company that's done very well this year. Brad, you were just mentioning Peloton having a bad year. As Peloton has struggled, companies like this, good old-fashioned gym operators, they've done pretty well.
Yeah, kudos to the team over at Planet Fitness, really instigating or at least triggering, I should say, a lot of the growth initiatives, starting with the high schoolers over the summer, offering some free memberships there. Perhaps that permeates throughout the households as well. We'll continue to keep a close tab on shares of PLNT. But taking a look at the DOW, the Dow Jones Industrial Average, we've opened up lower here on this final trading session of 2022. We're down by about 0.5%, and there you're taking a look at the year-to-date as well. That's lower by about 9% over the course of this year. Nasdaq Composite, you've got that opening lower by a little more than 1%. So tech-heavy average still under pressure there right now, down triple digits. Year to date, down 33%. And the S&P 500, that too, also opening up the day lower. It's down by about 0.7% after the opening cross here. Year to date, that's down nearly 20%. Let's take a look at some of the S&P 500 sectors here as well. And I'll give you two views. I'll give you a view first of how we're doing here today. Well, that's the year to date. I was going to come back to that. But anyway, intraday, we're seeing all 11 S&P 500 sectors open to the downside. And so since I teased it so eloquently there a moment ago, year to date, you're taking a look at some of the moves that we have seen. And we've got some deep lake red in terms of technology, consumer discretionary, communication services, actually the biggest laggard year to date, down handedly, well, down here today, intraday by about 1.2%, but year to date down by about 39%. And yeah, surprise, surprise, the only gainer over the course of this year, in a year that has seen a lot of geopolitical tension really thrust over into the energy section and trigger some activity there, and certain deals that have taken place between Russia, China, and then also some constraints on the supply side. Energy is the only gainer year to date on a sector basis, up 56%, Saz.
All right, well, one energy-dependent sector, of course, the airlines. We're also watching shares of Southwest this morning after the airline faced a brutal few days, leading to thousands of canceled flights. But one analyst at CFRA is not expecting this to have a long-term negative impact. Southwest says it's planning to return to its normal flight schedule today. And just going through this note over there by CFRA, this particular analyst, Colin Scarola, he really slashed his earnings estimates for, I believe next year, or actually the fourth quarter, to 120 from 186. So that was the full year estimate for him, but a major cut in large part because of a major hit to fourth quarter profits. And yesterday, I mentioned perhaps Ed Bastian, Delta CEO, and Robin Hayes over JetBlue should write an op-ed and tell us all why they are a different entity than Southwest. Yet Scott Kirby kind of do that last night over on his Instagram page. He said, you know what, guys, we were the best run airline during this whole entire weather debacle. He said we weren't perfect, but he thinks, of course, he's not going to say they sucked, but still, he thinks they operated very, very well. And just judging on their cancellations versus the complete debacle at Southwest, I would have to agree with Scott.
Yeah, for Southwest, what they had put out late yesterday, I believe it was, continuing to operate 1/3 of its schedule they had yesterday on Thursday, December 29th. Planning to return to normal operations, minimal disruptions expected for Friday, today, December 30th there. And they're saying that they're encouraged by the progress that they've made to realign crew. But there's going to be significant investments that need to be made from this company to better understand and have insights real time into where the crew is, where they may still be in air or where they're in transit to another location where they have to connect in order to make another flight happen as well.
I'll add this too. I'm really not a fan of that CFRA call. I understand where they're coming from. Pullback on the stock on this news, you would think maybe is some form of buying opportunity. But bottom line is, you do not know the longer term effects of this situation. Of course, there's a major earnings hit in the fourth quarter, but how long does this continue into next year? And that's very hard to estimate. As a former analyst, I wouldn't, it's hard to model these situations. They truly are the great unknown for companies.
It is difficult. And the other thing here too is to remember that consumers, even in times of an economic pullback, they're going to look for deals. And so they don't become as airline agnostic unless they have specific points or rewards or a loyalty program that they've been enrolled in. And instead, they will just go out and look for deals. They'll look for the best prices. So price competition or just buying based on price becomes prioritized that much more. So perhaps that's where some of this inclination for this note really looks at some of the opportunity for Southwest in that environment where if you did see a significant pullback that really hampered or dampened the ability for somebody to say, you know what, I only fly Delta, or I only fly United, or I only fly American Airlines, to say that, you know what, I'll fly anybody just as long as they got a cheap price.
Well, all these people that got stuck in airports because they got
it's frustrating.
Just really taken to the woodshed by the likes of Southwest. Come holiday season 2020-23, they're going to go online. They're going to see maybe an open flight for Southwest. And you know what? I'm not flying this airline.
Yeah.
I'm not flying this airline.
Yeah, the same way that I do with one. Guys, coming up on the other side of this short break, Yahoo Finance's Jared Blickery will break down the latest market action as we enter the final trading day of 2022. Welcome back to Yahoo Finance Live. We're about 8 minutes into today's trading session. Let's get on over to Jared Blickery at the Wi-Fi Interactive for a deeper dive into today's tape this morning.
Yes, well, we got to talk about the energy market because as you were just working your magic there over at the Wi-Fi Interactive, I'm going to go back to the year-to-date look at our sectors. Energy, the only thing in the green, and it is green by a mile, up 57%. And XLE, let me just show you a max chart on this. It's going to go back to the late 90s. Arguably, this is a triple top from the global financial crisis to 2013 and then into this year until XLE crosses this hurdle here. This is roughly 90 to about 110, 120. This is still potentially incredibly strong resistance. So I just want to throw that out there now. But let's go back to, let's actually go to our futures chart here where we see crude oil, that's up about 4%, Brent's up 4.3%. So we'll take a look at WTI. Here is a year-to-date chart of crude. And what stands out to me is it's only up 4%. So basically, crude oil round-tripped its entire gains. Now, this big spike here in February, March, that was the Russia-Ukraine conflict as it was erupting. That was just kind of out of the blue. And of course, more of that could emerge in the new year. Then we had the second spurt up to about 120. And it's been a slow, steady decline ever since. And OPEC Plus just at their last meeting earlier in the month, they left everything the same. So they seem to be happy with the way things are, maybe an equilibrium level in the oil market right now. So this is our energy stock heat map. And we can see Exxon, the biggest of the majors, that's up 79%, huge gains for any kind of company. But number one here is Oxy. I believe that's number one. And here's the year-to-date chart on this. Well, at 115%, by the way, this is the energy stock that Warren Buffett likes the most. Berkshire Hathaway has a huge position there. It's been rumored they might buy the company. To be able to consolidate these gains as we are having the worst year in years for stocks overall is incredibly powerful. But much like some of these other markets, at potential resistance as well. So long-term charts are saying we could be at resistance, but there's huge gains that we have made this year in some of these markets.
Jared Blickery with the technical analysis. Appreciate it. All right, some sad tech stats here to share. Several well-known tech stocks have had more than 70% plunges in 2022 as investors rotated out of riskier names. Snap has lost 80% year-to-date on the back of a few brutal quarters. Shopify has shed 72%. Stitch Fix, a perennial struggler, is down 79%. Roku is off by 78%. And Redfin has lost 88%. And around this all out, Fubo TV has dropped 84%. By comparison, the Nasdaq Composite is down about 29% on the year. Coming up, will Tesla really be a winner from the Inflation Reduction Act? We'll discuss next.
The U.S. Treasury Department and the IRS have unveiled additional information regarding the tax benefits included in the clean vehicle provisions of the Inflation Reduction Act. Yahoo Finance's Pras Subramanian joins us with the details. Pras.
Hey, Brad. So, tax law is not my thing, right? But we'll just briefly go through.
I have a T-shirt that says that, actually.
The big thing that they came out yesterday with in terms of like clarification on this law was that they revealed the pricing that cars qualify for the tax credit. So basically, a regular car needs $55,000 is like the limit, and then for an SUV or pickup truck, it's $80,000. But there's some weirdness with regards to some of these changes, right? So, for instance, a Tesla Model Y. Only the 7-seat version qualifies for the $80,000 higher up tax credit, right? So you can have like a more souped up version. The other cars are at $55,000. You can't get a Model Y five passenger for under $65,000, so that you can't get that car with the tax credit. Same goes with the Model 3. Certain version of it don't qualify. Then you have the Volkswagen ID4. The 5-passenger all-wheel drive version qualifies for the $80,000 or higher tax credit for some reason, even though the Model Y doesn't. So it's a little bit of strange weirdness there. Not sure why it's a bit inconsistent in terms of application, but this is the government trying to figure out what's a SUV versus what's a car.
One way to get around all this, just go and buy a gas car, right? They still work. You put a key in, you just turn it on, fill it up with the gas tank. But take us through some of the leasing provisions here.
Yeah. So quickly, the leasing stuff basically allows, there's a commercial lease provision that foreign automakers now say, basically the Treasury said that you don't need to have qualify for the North American Assembly, income requirements, etc. Basically what it means is that foreign automakers like Kia, Hyundai, BMW, Mercedes can now use the IRA $7,500 tax credit for leasing. So basically, if a company like a bank or an automaker is the commercial lessor, they can pass on those savings to you or I, leasing a car from them. So you can actually get a souped up car like a Mercedes EQS potentially, and get that tax credit. Now, Mercedes told me that they support legislation here, but they think that the current IRA has a multiple number of flaws, including the fact that the assembly requirements, battery material stuff, whole number of things. So they're not happy about that, but they are looking into this law, and it will benefit them from a lease point of view.
All right, Pras, hang with us. We're going to talk about a Chevy Bolt rival here as we continue on the road for EVs. It has been a bumpy road for Tesla this year as the stock skids towards its largest annual decline ever. So can it bounce back next year? Roth Capital analyst Craig Irwin joins us now. Craig, good to see you. So do you think Tesla stock could bounce back next year? And if so, by how much?
So I have an $85 price target and a neutral rating. I've had one of the most bearish price targets on this stock now for about 2 years. My thesis has been underpinned by the fact that Toyota makes about an order of magnitude more vehicles than Tesla. There's nothing that Tesla has that Toyota doesn't. But Tesla's been egregiously overvalued. So we have seen the repricing of Tesla throughout the year as competition has credibly come into the market, as people have understood the outlook for pricing pressure, and the longer-term trajectory where everyone assumed that Tesla would operate in a vacuum hasn't come together. Forget about robo-taxis and the other daydreams that were out there. The company's been executing, but not nearly as well as the daydreamers. So the lofty valuations come off, and it has to come back to earth. So I think Tesla's short-term trading is really going to be a function of whether or not Jack Dorsey goes back to Twitter, or maybe Dick Costolo, put Elon's focus back on the company and on driving units. Mm-hmm. But they're having problems, right? That's why they're discounting. So I'm still bearish. I'm sticking with my $85 price target. There's a short-term relief rally here.
Yeah, Craig,
but
Craig,
I think
on that price target, that assumes about 31% downside from current levels.
Yes.
Yeah. Do you want to go to a sell rating here, and what ultimately sends the stock down 30%?
Excellent question. So I am very bullish on the EV industry, right? EVs are inevitable. They're going to continue taking market share. Tesla's a pioneer. They deserve credibility for that. And I've always believed that there are very specific levers that Elon Musk can pull. He would call them levers. Specifically, I'm excited about the mini car. I think that expands their market greatly, gets them into lower price vehicles. And I think it was a very big mistake for them not to move forward with the concessions necessary to produce in the Indian market. The whole strategy of doing knockdown factories where they sort of incrementally source parts locally, not going to work in India, but the Indian market is a tremendous market, just as important as China. If they were to get back on track with those two things, you could see me actually turn constructive. because the growth here is amazing and they're dominating. But I just right now think there's much better places for people to put money.
Hey, Craig, Pross here. So talking about stateside and about the IRA that we were just talking about earlier, do you think that Tesla's not going to really benefit from the changes to the law that are coming in on the first introduction? They're back into the regime. They're also getting that potential of a lease credit there. Or do you think other automakers like GM are better situated?
So it is unfortunate that Elon Musk has had a semi-antagonistic relationship with politicians of one party, right? It's unfortunate. When laws are written, when tax laws are written, it's quite strange how sometimes some vendors can be written in, some can be written out. I'm no expert on tax law, but I did appreciate your piece just before this interview. I think it could be problematic for them to pull down the subsidies, right? These are going to be very, very good for electric vehicles, but it looks like they could be better for competition than for Tesla. Now, if they're able to qualify for the 55 or other things, we will have to see them come up with cheaper cars. So therefore, pricing pressure as they downsize batteries, give away range, decontent things. So call me a skeptic. I think they face pricing pressure and negative estimates momentum for a sustained period. That's not going to drive valuation in a growth stock. It's a growth stock. You need positive estimates momentum for a growth stock to work.
So, all right, now that 2 out of 4 of us in this conversation are not experts in tax law, let's focus in on the fact that you just said they're going to need to create a car that perhaps has more production synergies, similar to what we've already seen between the 3 and the Y. So if we see more of that in the future, does that mean less sexy, fanfarous vehicles coming to the market from Tesla? And where does the rest of the auto market and the competition that's ramping up their production on the EV side and already been taking orders, where do they start to take share?
So, small cars don't have to be less sexy, right? Look at the Mini Cooper. That is a great vehicle. It's been,
that's not a sexy car, Craig.
Oh, Craig, come on. I was liking your rating and everything, and then you dropped that comment. Oh, Craig.
Come on. No, a lot of sort of Gen X, Gen Y people like that car. BMW makes great money with that car, and they've made it, a VDL net car for all these years. Now they've only just pulled in production, so they're going to make more money with it. I think something like that could be a tremendous seller in Europe, probably in India, in other international markets. You and I might not buy one. Heck, I probably wouldn't want to be seen ever in one of those. But it's a cool car. It's sexy. A lot of the kids love them. A lot of the teenagers and people in their 20s and 30s love small cars like that for the practicality. And the Europeans love them too. So we have to be realistic about that. And a lower priced featured car, it could be a driver of long-term growth. And, it doesn't have to be low margin, which is what BMW has proven to us.
All right, we're going to workshop the Mini Cooper as sexy with the Yahoo Finance viewers and listeners. Thanks so much for joining us here today. Craig Irwin, Roth Capital analyst, alongside Yahoo Finance's Pross Supermania. Happy New Year's to you both.
Happy New Year. Thank you.
Thanks. Coming up, continuing our Tesla discussion, Saz will share 3 ways Musk can get Tesla stock back on track in 2023. That's coming up. Tesla closing out a year where its once hot stock price crashed about 70%. Analysts pin the blame on Elon Musk's new CEO role at Twitter, but slowing sales in the U.S. and China, they've not helped investor sentiment. Sazi is here with a look at 3 things that could reawaken Tesla stock in 2023.
Yeah, things unrelated to Elon Musk stepping down for Twitter, and hat tip to our friend Dan Ives or Wedbush for putting together a list of this. He actually put together 10. I have more of those in an article on our homepage right now, but I really want to zero in on 3 because I do find all of them pretty interesting. Number one, at least from Ives' perspective, he thinks board of directors changes with some more experience around tech and EV leadership. If those changes come to pass next year, that would be good for Tesla stock price. Of course, worth mentioning, Kimball Musk, Elon's brother, is still on this board. Unclear to me what he really truly knows about electric vehicles. Also, Rupert Murdoch's son, also on that Tesla board, a friend of Elon Musk. Both of them maybe not exactly EV thought leaders. So next one, number 2 up here. And this is something that Elon teased, I believe, on the last earnings call. Ives thinks announcing a major stock buyback program is an important key for the street's confidence in Tesla shares. Surprised we have not seen this buyback yet, given how far Tesla stock has come down. But Musk teased that he may do something big, those are his words, on the last earnings call, perhaps a big buyback next year in the $5 billion to $10 billion range. So I do think investors will be looking to hear more on that, or actually just getting the plan when the company reports its fourth quarter earnings in a couple months. Number 3 here, more financial metrics and transparency around the margin structure. Please, this has been a long-running gripe for analysts that cover Tesla. They want more information and disclosure on what is driving Tesla's gross profit margins and operating margins, especially as it ramps up production at the likes of various gigafactories and, of course, that factory in Shanghai. My take is this, after a wild year of covering Tesla here at Yahoo Finance, clearly Tesla needs to come out of the gate in 2023 blasting, and maybe it is a big, bold stock buyback. This is a company that ended the third quarter with close to $20 billion in cash. Finally, they do have the money, Brad, to come out here and buy back stock at a time when the stock has been hammered. That would send a major signal of confidence, I would argue, to investors.
You know, in the buyback, I guess the only thing that I would push back on is if you're an investor, what would you want to hear a company like Tesla doing? Is it spending money on your own stock to buy back stock to prop up the actual price of it and appease some shareholders? Or would you rather see Tesla, even in a highly scrutinized environment for any M&A that takes place, buy out one of the materials partners that they have in order to ensure that they have a constant flow of supply at a time where some of those suppliers may also be ratcheting up prices still?
Yeah, and that's something Elon has talked about. And he very much, I do think, wants to control his own supply chain and not rely on some of these companies indirectly. That is another good suggestion. Ives did not mention that, but something they could certainly use their cash to. I just do think buying back some stock here, announcing some form of plan, even if it's $1 billion, just changes or starts to change discussion on Tesla being a crashing stock, and perhaps investors could focus or refocus again on the fundamentals of the business.
All right, a little bit of a Band-Aid for sure, at least in this interim period. Coming up, everyone, what we can expect from the Fed in 2023. We're going to speak with an economist from Jefferies coming up next.
Welcome back to Yahoo Finance. I'm Brian Sazi alongside Brad Smith. Julie Hyman has the day off. Markets, well, they're limping into year-end. Pretty fitting, given how the year has gone. All three major indices right now are in the red at this particular moment. Here's what's on tap this hour. A bad year for stocks leads to some interesting search terms for investors. We'll have more on this with Investopedia's editor-in-chief, Caleb Silver. Best fintech play for 2023. Mizuho's Dan Dolov stops by to reveal his top fintech play and ones he thinks you should avoid. And Brad and I will make a few predictions of our own for the new year. Brad, I am very excited about sharing my predictions. I am super pumped, but I do predict you and I will be here.
Yes, that is a very good prediction and one likely to come true as well. Taking a look at the Dow Jones Industrial Average, it's up right now by about, it's down right now by about 0.7%. A prediction that is not coming true. The Dow moving higher within the next 5 minutes. It probably won't, but as of right now, you're seeing it down by about 0.7%. Nasdaq Composite, as you mentioned a moment ago, saw is down by about 1.1%. S&P 500 also down by about 0.8% over the course of today's trading activity. We're only about 32 minutes into the start of trade. I did want to point out something else because we do have light volume this week. These are typically some of the days where trading desks might be a little bit more sparse or empty than usual. And so you have some light volume, and that's contributing to the volatility that we're also seeing on the day. You've got the SIBO volatility index, or the VIX, the fear gauge index. You're seeing that up by about 3.7% here on the day's activity. And then the VIX of the VIX, you're seeing that top about 78 right now, 1.2% higher. Let's also take a look at some of the activity we're seeing in the Nasdaq 100. We'll put this on an intraday view for you, just so you see exactly what we're taking a good look at here. And that's really only three movers in positive direction right now. And that is Tesla, CrowdStrike, and Gilead, holding on to those gains by the hair of its chinny chin chin, it seems, though. But the biggest laggard on the day is Moderna, ticker symbol mRNA. It's down by about 3% right now. But you take a look at some of the year-to-date activity that we'd seen, and many of those biotech names have actually led the charge over the course of this year. Gilead, Amgen, you additionally got Biogen, Regeneron up there as well. And so some of those gainers that we've seen over the course of 2022 as we head into the next year. Well, switching gears, the Fed might be looking to labor data indications that its hawkish policy is working. The market may be underestimating its resolve to continue hawkishness. Let's look ahead to Fed policy and markets in 2023. Joining us with more, we've got Thomas Simons, who's the Jefferies senior money market economist. Thanks so much for joining us here this morning. First, when you think about what the Fed would be looking to see and the trend and how long that trend would need to be locked in order for any type of policy pivot, what comes to mind for you? What type of extent or timeline would that even look like?
Yeah, so I think the key right now is something that they've been talking about recently as a component of the inflation data, which is core services. Obviously, we've seen quite a slowdown in the headline inflation data recently. Most of that has been driven by used car prices falling, a couple of different things that really rose to outsized levels in 2022. They're starting to roll over. And when you look at those headline levels and you annualize them, a lot of people are saying, hey, the Fed has done a lot of work. They've already gotten inflation down to levels that are close to the 2% target if it stays there for the next 12 months. But really what the Fed is saying is like, okay, we're happy with that, but there's this other sticky component of inflation that hasn't come down yet. And these are the most labor market intensive sectors as well. So as we continue to go through this period of time where labor is really difficult to find, the labor market remains very, very tight, and wages continue to be, seeing some continued upward pressure. The Fed is going to continue to be concerned about that inflation component, and I think that that's the key factor that really isn't appreciated very much by the market just yet. As you mentioned, there are, I think expectations that the Fed is going to pivot or slow down at some point here. Very soon. We think that there's still at least a couple more rate hikes here before they're done.
Thomas, what's your boldest economic prediction for next year?
Like one that has a reasonable chance of coming true, I suppose.
One that might surprise folks.
Okay, so I think I'm not sure if this is a huge surprise, given that the Fed has more or less communicated this with the recent dots, but the Fed funds rate target is going to be over 5%. From March all the way through the end of the year and into 2024 as well.
And so, Thomas, when we think about what parts of the consumer experience right now are going to change drastically, and where the consumer, within what the reality of the economy may look like in 2023, where they net out. I mean, what type of impact should they be bracing for?
Well, it's actually interesting. It's one of the things that has really propped up the consumer throughout this cycle, which is that the consumer is far less interest rate sensitive than it had been in previous cycles. So where previous cycles consumption have been really fueled by a lot of debt, obviously higher interest rates is going to affect consumer demand for borrowing. But in this cycle, really what they've been working through is all this accumulated savings that they've accumulated through whether it was stimulus back in 2020 or 2021, but also the continued wage gains through the last couple of years as well. We still think that there's some more ammunition on those consumer balance sheets. So as interest rates rise here, it won't be quite as painful for consumers as it would have been in the past. The issue is going to be whether or not the labor market can hold up through the entire year. We do expect that into Q1, we're going to see some pretty significant margin compression across earnings reports that from big businesses, and eventually as they go through cost cutting, that is going to lead to layoffs and obviously a higher unemployment rate and lower wage pressure. So I think the consumer starts to feel that around the middle of the year. That's when the tightening is really going to start to take hold, and we are going to see sort of people on the fringes of the labor market really start to suffer. But it's not something where we're going to see a big rollover, a big collapse that is akin to unemployment rate spikes that we've seen in the most recent two cycles anyway.
Is the economy shedding jobs by the middle of next year?
I believe so, yes. I don't think that we've seen it yet. It's interesting to me that we've seen a number of big announcements for significant layoffs from a lot of major publicly traded companies. But if we look at things like the initial jobless claims data, you don't really see much evidence of the layoffs coming just yet. So I do think that there's a few more months where businesses struggle with this idea that they had just worked so hard to find these people to fill open positions, and they're going to delay the layoffs as long as they can. But into the middle of 2023, I don't think that they're going to be able to hold on too much longer.
Yeah, Thomas, I think about leisure and hospitality that is still recovering from the pandemic. And so what does that sector specifically look like if you see, number one, a drying up of some of the consumer dollars that may have been spending onto that experience economy or that service, and then number two, the fact that you don't have enough people perhaps to really supply what that service or what that experience may have looked like?
Yeah, it's one of the biggest challenges that the Fed faces right now, because if you look at previous cycles when we've gone into recession, leisure and hospitality spending actually doesn't pull back that much. People, even when times are bad, still try to find some modest way to entertain themselves, whether it's going out to eat at a cheaper restaurant or like seeing a movie instead of going out to, on a day trip or something like that. They do continue to spend in those areas. So I expect that we will not see as much sort of rollover in leisure and hospitality. I think the demand will still be pretty good. Therefore, those businesses will still have demand to fill positions that they can't fill at the moment. And I do think that that's going to continue to prop up prices as well, because if those businesses are struggling with costs and they can't let go of labor because they would just not be able to meet demand that's still there, the only way that they can address that is through further price increases. And again, this is what the Fed is talking about when they're looking at those core services.
Thomas Simons, Jefferies money market economist. Good to see you. Have a happy new year.
Thanks so much. You too.
Thanks. All right, before we head to break, let's spotlight two bullish calls on Amazon and Google by our friend Mark Mahaney at Evercore ISI. Mahaney thinks Amazon and Google are best-in-class assets that may see slight downside in the first part of next year, but both stocks look attractive, Mahaney says, on 2 to 3 year time horizons and carry material value unlocks that could occur in 2023. Coming up, more headlines emerge from the fallout of FTX. Brad is back with that, plus more top headlines you need to know next.
Let's get down to business. Here are some of the top headlines that we're following for you this morning. The Securities Commission of the Bahamas has moved $3.5 billion from FTX's Bahamian subsidiary, FTX Digital Markets, into its own digital wallet, according to a Thursday-dated media release. The commission says the funds are being held on a temporary basis until the Bahamian Supreme Court directs them to distribute the funds to customers and creditors or liquidators. The funds were transferred on November 12th after FTX filed for Chapter 11 bankruptcy. Russian President Vladimir Putin and Chinese President Xi Jinping held a video call earlier where the two reaffirmed ties. Putin said that despite rising geopolitical tensions, the relationship between Beijing and Moscow is stronger than ever, with the two countries representing a model of cooperation between major powers in the 21st century. Putin also noted that the Kremlin aims to strengthen cooperation between the duo's forces. In response, Xi said Beijing was ready to increase strategic cooperation with Russia. Brazil is entering 3 days of mourning as well here in another headline that we're following in the death of the country's national treasure and three-time World Cup winner known worldwide as Pelé. Regarded as one of the most commanding figures in sports and labeled the greatest by FIFA, the international icon died Thursday at the age of 82 due to an organ failure caused by the progression of cancer, according to a statement from Albert Einstein Hospital. Meanwhile, the fashion world is paying tribute to English designer Vivienne Westwood, who also died Thursday. Westwood was a fashion maverick who played a key role in the punk movement that later went on to enjoy a long career highlighted by activism. Her fashion house said in a statement that she died peacefully in South London, surrounded by friends and family. She was 81 years old. Saz?
It's almost the new year, and for business news, that means it's covering the predictions for the year ahead out of the big banks. To that end, Saxo is cranking things up a bit here with 10 outrageous predictions for 2023. And Brad, two of these definitely stood out to me. First, Saxo thinks gold prices, which are under $2,000 an ounce now, could hit $3,000 an ounce, really on three factors, all of them tied to, I would say, rising geopolitical risk and what the Federal Reserve banks around the world may or may not do with rates. And the other one here, we were talking about Beyond Meat earlier on the show. Saxo thinks a country agrees to ban all meat production by 2030, of course, as countries increasingly focus on climate change. If those two things happen, that'd be pretty bold.
This was the other bold guess that they had made, or prediction that they had made, was that the UK would hold un-Brexit referendum. Now, this is particularly interesting, and I imagine for at least one of our viewers, particularly because it's following a recession and domestic pressure here. But it says that this estimation is based on the UK thrown into political turmoil that will end with a vote to wind back Brexit. Now, that would have major market implications. We had remembered back in 2016, and I believe it was actually in concert with the day that there was a Russell rebalance also taking place. So you just had this wild market swing that was taking place, and the Nasdaq moved lower by about 4%. S&P 500, the Dow were rattled extremely because you had essentially the unwinding of currency that was taking place between the UK and the rest of Europe. And so that particularly, I think, is unlikely to happen, but it's a prediction that Saxos decided to put as a part of 2023's outlook that they are also including within this. OPEC and Chindia walking out of the IMF and agreeing to trade with new reserve assets.
But I sure hope the U.S. doesn't ban meat. Come on, I gotta get my tomahawk steak on. I mean, I appreciate climate change, but I need my tomahawk steak. And to that end, Sazi Bank coming out with prediction for next year, and that is Tim Cook over at Apple. He's been the CEO for 11 years, of course, taking over from Steve Jobs. I think just given everything, the past challenging few years in terms of COVID, everything that's going on in the world, of course, Tim Cook just driving, I would say, tremendous leadership at Apple over his tenure, really doing a phenomenal job by most, if not all measures. I think next year, Brad, could be the one where he signals who his successor will be at some point. You do not hold a CEO job forever. Tim is 62. No clear signs he's slowing down or wants to give up that CEO position. But at some point, you have to signal who will be your successor, and maybe he moves to an executive chairman role.
Well, Brad Equity Partners also has a prediction here, and from my perspective, one that I would be looking for going into next year. Keep a close eye on names like Nike, like Lululemon, and why? Because I think you've got a name in New Balance that is actually really gaining some traction among young buyers that are out there in the market looking for some new apparel. I think it's entering even more so into the hype beast landscape. And even with New Balance, you still have somehow Crocs sticking around and holding on to some of the cozy market share right now too.
So you're not on the Julie Hyman Hoka hype train?
I'm not on the Hoka hype train. I also have not tried out Hokas, so I need to say that as well.
Okay, but New Balance.
But New Balance makes very good casual shoes. I think in casual wear, I think in some of the performance wear as well, they're starting to really catch some attention. At least it's a larger question of for the partnerships that they've been able to net, Kawhi Leonard being one of them, how that performance side continues to hold up in the future, and then in skateboarding as well. I think they've also taken on a lot of the attention, and of course there have been major investments. Nike SB continues to crush it, but it's a lot of the collaborations and limited edition runs that are really taking the cake there for Nike, and they continue to be a powerhouse in that. No flies on that, but I think with regard to who's taking share coming into next year, I think in 2023 we could see more of a continued shift among younger demographics to New Balance as well.
In break, I'm gonna tell on you to Julie, and I think she's gonna yell at you.
Well, I just need to try Hoka. I just need to try them out.
Texting Julie. Julie, we love you. We
Deckers,
love your Hokas. All right, coming up, a tough year for stocks means some interesting finance terms we're searched for on Investopedia. More with on all of this with Investopedia Editor-in-Chief Caleb Silver. That's next. While sentiment on Wall Street is still highly cautious, investors seem to be slightly warming up to stocks, according to an Investopedia survey. Here to talk about the year in review and what to expect for next year is Investopedia's editor-in-chief, Caleb Silver. Caleb, good to see you in the flesh here at Yahoo Finance HQ. Love your terms. One that stuck to me is cold storage. I guess no surprise given everything that has happened in crypto.
Yeah, cold storage was one of the top 10 search terms of the year in terms of traffic outside of its normal range. And why did that happen? bankruptcies at FTX, bankruptcy at Celsius, people wondering where their Bitcoin is or where their tokens are. If they didn't have them in cold storage or in a cold wallet, some of them may have lost it forever. So everyone was looking that up right as these cryptocurrency exchanges were collapsing.
So what's the prediction for next year? What do you believe people should be placing their attention on as we get into 2023?
Well, we know folks are going to be focusing on the terminal rate. What's the terminal rate? That's the end rate at which the Federal Reserve may stop raising rates. People have been very fixated on our central bank this year for good reason. So the terminal rate, that looks now north of 5%. Is that going to be right for 2023? We will see, but that's a big one. Also, folks are going to be looking at the wash sale rule. If you sold some of those stocks at losses this year and you want them buy them back a little bit cheaper, you can't do that and take the tax deduction. The wash sale rule, very popular at the end of the year here in 2022. We think it's going to be popular in 2023 as well.
That's a good one to look up. What about recession? We've been talking about recession, I think, since January of this year. Are people still searching for that as much as they were 6 months ago?
Absolutely. And recession is the number one concern among our readers in terms of what they're worried about for 2023. They got a little bit warmer to stocks towards the end of the year with a little rally in November. December didn't do much for that. But people have been worrying about a recession. But as you guys know, recessions, it's a big economic term. There are indicators, but it's also very personal. So for a lot of folks, they feel like they've been in a recession since 2020, since the onset of the pandemic, especially small businesses and lower income folks. We know that's going to be popular in 2023.
Okay, and so we have essentially seen many different variations of bear markets in the past, but this one much different because we're coming out of a pandemic. You've got global uncertainty continuing to move forward, even as we were talking about a pact between Russia and China that continues to emerge. So with the reality of what we could see on a continued basis in the bear markets of our time, and given the confluence of factors that we have right now, where is that stacking up among some of your readers as well?
Yeah, they're worried about it. At the same time, they want to be opportunistic. For a lot of younger investors who came into the market in the last couple of years, or even over the past decade, they've never seen a dynamic like this. Rising interest rates, sticky high inflation. Used to be able to throw a dart at the dartboard, hit any growth stock and make some money on it. You can't do that anymore. You got to be smarter. You got to focus on fundamentals. Boring guys is back. You're getting some yield out of the bank right now. You're getting yield in money markets. Value stocks, it's the tortoise versus the hare in 2023. We know a lot of folks are going to be thinking about that portfolio migration to the slower moving, more steady fundamental stocks.
Do you think investors just learned something this year? Like, what did they learn this year, Caleb? They've been battered on tech stocks that only in the past have gone up. I mean, what are some of the top takeaways for investors this year?
Yeah, I think a lot of it is people are figuring out what their sleep factor is. What is the losses they're comfortable with holding on to before they capitulate? So a lot of folks have had to think, do I sell into a downturn? Do I sell into a bear market? A lot of our portfolios, a lot of folks were invested in growth. Do I sell out of this now and transition? So they were learning about what to do next and how to position themselves. But you know, there's always some opportunistic investors looking for yield, especially when everyone gets scared. A lot of people get very greedy, so we're going to be watching for that.
Yeah, you would imagine it would be very helpful for them to have more financial literacy knowledge early on in their career. They'll have a lot of stuff coming at them. What are you working at? Investopedia.
Amen to that. We believe in financial literacy at every age, but we're trying to push it younger and younger. So we're working with public schools across the country to try to develop curriculum to really help people not just invest, but understand money writ large. We don't learn that stuff at all pretty much in high school. Now it's required in 26 states, but we really don't learn the basics. Guess what happens? We go to college, we get the credit card offer. Some of us graduate with student debt, about $35,000 on average. The first job's not going to help you pay that down. So we need to teach people the fundamentals at an early age so that they're ready for their money lives, because it's a long journey, as you know.
Yeah.
Investopedia Editor-in-Chief Caleb Silver, always a pleasure to see you, and great getting some of the insights from the platform. I know you're a skateboarder, so we've got a couple 50-degree days coming up here in New York City. We're going to get another check-in from the skate park out there, too.
Roll on.
Guys, coming up, our next guest said crypto was dead following the collapse of FTX. We're going to get the latest take from Mizuho's Dan Dolev. That's next.
Cryptocurrencies have been under pressure throughout 2022, but some tokens have managed to remain resilient. Here for more on the tokens that held up best is Yahoo Finance's crypto reporter, David Hollerith. David.
Brian, in a year where cryptocurrency prices have plunged, it's admittedly kind of tough to use the term best performing crypto assets, but we can definitely look at the results to see what's held up best in 2022. So, for example, it's a little bit of a head scratcher. TRX, or Tron, commonly known as, has held out better than the majority of assets with a 30% sell-off. OKB and BNB, which are two tokens issued by cryptocurrency exchanges, OKX and Binance, also held out better with a 15% and 54% loss, respectively, and down by 61% year to date and trading around 67 cents. Dogecoin, the original meme coin, has beat out Bitcoin and Ether, two of the largest and most liquid cryptocurrencies. And this is due in part to a Q4 rally that was sparked around the time that Elon Musk purchased Twitter. Now, of these results, Rich Rosenblum, co-founder and president of the crypto market maker GSR, said, while unexpected, the better performing cryptocurrencies during the year were virtually all digital assets that appear to have been of smaller size, meaning they were probably less liquid. And Rosenblum went on to call a lot of the performance of these tokens market anomalies. Outside of Bitcoin and Ether, he said that the firm, which is one of the most active traders algorithmically and by appointment, doesn't actually trade any of these or deal in any of these tokens. So, you know, in a year where cryptocurrencies have all sold off, the ones that have performed better turn out potentially not to be as much about, you know, what could be indicative of future performance, but more so how liquid tokens are and what's more easily sellable during a time of a crash.
David, a lot to continue to track within this crypto landscape amid this washout or winter or whatever W word people want to use today. Dave, we appreciate the continued coverage. Thanks so much. Switching gears, well, actually staying with crypto for a hot second here. The outlook for cryptocurrencies going into 2023 remains cloudy as many tokens lost steam after investors got burned by fraudsters and crypto scams. Yet the rise of digital assets, blockchain technology, and decentralized finance, it remains dazzling to investors who see increasing utility in the space. So could 2023 be a profitable year for those involved? Big question. Mizuho Managing Director and Senior FinTech Analyst Dan Dolev joins us now to discuss. Dan, I have an idea of what you might say, but I'm just going to let you say it first. Do you believe that 2023 will be the year of the rebound for crypto?
No.
Okay, and why?
Is that it? Can I go? No, I'm just kidding. Look, I think I was just listening to the show. Love the show, by the way. I was basically tuned in from the beginning, and I just listened to the last segment, and I was like, wow. I mean, what are we talking about here? I mean, we're talking about, you know, pet rocks, right? Or tulips, or, you know, it's just like no intrinsic value to any of this, right? It's almost, it's true nonsense. If you think about, you know, Dogecoin or Solana, they're hanging up in the air. Some days they're up because, you know, someone's buying, some days they're down, but there's no intrinsic value. It's not like equities. And I think that's the fundamental flaw with those crypto tokens, is that there's no, they're literally bottomless, and at some point we're gonna see, you know, more pressure on the whole industry.
Okay, and so just to follow up on that, in this crypto winter, do you believe that there could at least be some shakeout of the unintrinsic or unviable projects that still exist within crypto, and then leave perhaps some strength or some confidence in those that have true value or true technological prowess for the future?
I mean, I cover my expertise is I cover, you know, some of the equities that deal with crypto, so like Coinbase or Robinhood or even Block, or AKA Square. When I look at Coinbase, let me answer your question differently. When I look at Coinbase and I think about those projects that you're talking about, right? So they have other revenue streams which are non-trading related. if you think about them, they're almost perfectly correlated, or they move in tandem with the crypto trading, which means that there's really no excess or excess kind of benefit from idiosyncratic outperformance of those of those revenue streams outside of trading. So if crypto trading, if the crypto winter turns into a crypto ice age, which I think that's kind of where we're headed to, those projects I think will also take a back seat as well. And I think that's the concern, is that they're only as good as the volatility in crypto and the rising prices.
Dan, Coinbase shares just hit a record low on Wednesday. Where does that company go from here?
I have a $30 price target. So, and I think we're getting close to we're at 35, right? So, I think it's a really, really, really tough spot, right? I mean, we've been talking for over a year about this, and I've been a bear since the 300s, and I think this one is, think about how they make their money, right? It's just trading high commissions on retail trading, and some U.S. stable coin that they're getting from Circle, and I think all of that is threatened in 2023. So I think it goes to 30. I think the company is going to have to cut costs. I think their costs, they're burning way too much cash, right? And I think 30 is kind of our benchmark, but I wouldn't be surprised if it actually dips even below that.
We were just having a conversation with Caleb Silver, the editor-in-chief over at Investopedia, and we're discussing how cold storage was one of the most searched for terms in 2022. Robinhood or Coinbase more notably there, has a part of their business that they wanted to build out for custody. And so for some of the custody plays that we had seen for equity traded companies like a Coinbase, does that mean that they just are going to have to live with the reality that a lot of people who may purchase crypto from this point forward are going to be more comfortable having self-custody in cold storage rather than employing one of the services that the platform that they purchase from offers to them?
Yeah, I would agree. I think it's actually really interesting that it's like almost like Pavlovian reaction from people, right? And it to me it feels like a little bit like buying toilet paper ahead of COVID, right? Remember that, March 2020, right? When nobody was able to explain why people were rushing to buy toilet paper. I was
trying to forget, Dan. Thanks.
I'm always here to remind you of the fun stuff. So to me, this cold storage thing is the same reaction. So they see FTX implode, they see what's happening out there, and the fact that it's very unsecure to keep your assets with a lot of those exchanges, and they go like, what am I going to do with my crypto? So they still believe in crypto, and they put it, or they search cold storage. I think if the next step would be understanding what's the value of these tokens, and I think that hasn't really fully kind of sunk yet. And I think when that sinks, people are like, wait, what am I cold storing? Dogecoin, right? So I think it's kind of it's like a one punch, two punch thing. First reaction, run to cold storage, and then assess, wait, what's actually stored here? But I would agree fundamentally. I think I can see why there's this trend towards cold storage right now.
Dan, do you think the market appreciates how much in terms of costs Robinhood has cut from its business in the second half of this year?
Not really. It's a great question. I mean, I'm a big fan. While I'm a huge bear on Coinbase, I'm a big fan of Robinhood, and I think that one of the reasons is because crypto is only a small fraction. I met with Vlad a few weeks ago, and just the momentum there. I think I've never seen them so upbeat about the momentum, and the cost basis has definitely come down a lot. And I think they're done with cost cutting, actually. So I asked about that question. I think people don't appreciate what they've done so far, but I don't think you'll see much more down the road. The key thing about Robinhood is 2023, while we're on that topic, is a year of massive innovation. Like you just saw the retirement product coming. You're going to see more. They're going to expand internationally. It's a real singularity. If you think about it, 3 years ago, you had Robinhood, you had eToro, you had Webull. I mean, there was a bunch of sort of copycats. Robinhood, they're basically the only name in town for kind of younger trading, and the brand is epic. So I think that is the kind of the Apple or whatever, the Google or the Amazon of young people trading, and it has a huge bright future.
Super helpful insight as always. Mizuho Managing Director and Senior FinTech Analyst Dan Dolliver. Good to see you. Happy New Year.
Thanks. Happy New Year.
Coming up, Yahoo Finance Tech Editor Dan Halley is here with an interview you won't want to miss. We'll be right back.
For the past few years, we've been told that AR, VR, and the metaverse will take off, but 2023 could truly prove to be the year that we see those technologies go mainstream. And here to talk to us about it is HTC's Head of Americas, Dan O'Brien. Dan, thanks so much for joining us this morning. I kind of want to kick it off with just a discussion on where you see the state of the industry at this moment. Obviously HTC makes headsets that flirt with the metaverse. Work in AR, work in VR. So I kind of want to get your sense of where you see the industry at this moment and if we are, in fact, moving into more mainstream consumers in 2023.
Dan, thanks for having me on. Where we see things is in a very healthy state. We look at some comparative metrics and previous innovations and products, and HTC was an innovator in smartphones for a lot of years before they were even called smartphones. So we've kind of seen this really go over a series of years before you get to mass consumers. We see a really healthy growth and adoption of XR technology in B2B and enterprise professional use cases across healthcare, automotive, education, architecture, engineering, and construction. So we're seeing really, really great adoption of the technology in these different spaces where we see it being used for human performance improvement, education, and simulation and training. But we're seeing also really good, healthy growth on the consumer side. And I think these markets and these products are being very complementary to each other, where we get to bring a lot of innovation into B2B and enterprise and have that technology move into the consumer products. Then we start to really bring consumer-friendly products in terms of better fit, better ergonomics, less intimidating, a lot better content, and it's just a lot more, ease of use, and being able to use it in a wide variety of different places, besides, just a single room. So you can kind of take this technology on the go with you. We also see where the technology is moving away from just a virtual reality device or just an augmented reality device. We're seeing now devices that are able to do virtual reality, extended reality, meaning like mixed reality. So it's like 50-50 of like 50% real, 50% digital augmented, and then moving into headsets that will do augmented reality as well. So you see these things that were very, very clunky large headsets now moving into these very wearable glasses types of scenarios and doing multifunctionality capability.
Well, I want to talk, we have obviously CES coming up, the Consumer Electronics Show, in the next week. And I know that, HTC will be there. What kind of, excitement can we expect from you guys? Obviously, knowing that you probably don't want to announce exactly what's happening.
Yeah, thanks. I appreciate that. We are announcing a new flagship product at CES this year. That will be on January 5th. We are very excited to announce this new product. It will be very consumer focused. And I think a lot of people have seen where HTC in the past with the original Vive products, we were very consumer gaming oriented focused with our partnership with Valve. And, we've really grown into the enterprise and professional space. This was all very, very intentional about, how we thought the market was going to grow, where we thought we could bring great, great value. And now we're seeing, hey, we can actually bring a lot of value with a mixed reality headset, and that can do different types of user experiences on an entertainment, gaming, and consumer standpoint. And we can bring that into now a new consumer product that we'll be announcing in January. So be much lighter, easy, flexible, take it on the go with you. We're really excited to get people into this headset and get them using it.
One of the big competitors in this space, obviously, we can't talk about AR, VR, or, anything along those lines without mentioning Mark Zuckerberg and Meta. I guess, their strategy is all consumer at this point, though they seem to be dabbling a little bit into the enterprise with their team up with Microsoft. I kind of want to get your thoughts on where they're going and, how their strategy compares to your own as far as getting into these spaces.
Sure. I think, Meta is a great company and they're doing a lot of great things for the industry and for developers, and trying to do their best to grow the industry. We have different business models. Our brand stands for technology, innovation, creativity, and humanity. How we approach the market and the types of products and solutions that we bring in is really how do we open up creativity using this technology, and then how does it benefit humanity? So we are focused on areas with enterprise, like in the healthcare field. Working with the Yale Medical School, they see 6 times fewer errors by doctors that are trained in in an immersive headset or an immersive training solution. That's a significant reduction in errors in a surgical space. Retention rates for education is 75% in an immersive space versus 5% for reading, or 15% for lecture style. So we see with our brand and our purpose and what we're doing to be very, very focused on bringing humanity a lot of really, really great solutions. I think, from a competitive standpoint, and how they've really tried to grow the consumer market by subsidizing hardware, it's setting the market expectations for the technology to be much, much too low for the real costs of the hardware. And at the end of the day, we don't actually data mine our customers. We don't have a platform or an infrastructure to do that, to eventually then make money off of selling ads later. In that case, like we deliver products and solutions to consumers. In their scenario, the consumer is actually the product. So we just have very, very different business models, and how we're approaching the market and how we're approaching it with the technology. So we see great value on the enterprise professional side, bringing consumers and those consumers great value, reducing their OpEx, reducing their CapEx, increasing their efficiency on their training and simulation. So we're bringing great value to them and actual cost reductions and efficiency increases. Whereas I think if you're only focused on subsidizing and you're only doing all these other things on the consumer side, you're going to lose billions of dollars every quarter, which makes it very, very hard for competitors to want to get in there and actually compete, in that space. And so that's very challenging for the market to then grow, to a really, really significant user base, right? And so that actually slows down the market, if you ask me. If you have a lot of competitors and everybody's kind of fighting, fairly with, their true costs, you'll actually get supply chain reductions and economies of scale inside of the supply chain that will actually naturally bring the costs of the products down much more. But we're also focused on bringing real innovation into these types of products where, these future products will be multifunctionality, like I said earlier, of virtual reality, mixed reality, augmented reality. The future of these products will be connected over a 5G network. There's very few companies in the world that know how to make a radiated product like a smartphone that can actually do that kind of stuff. And so these products in the future will actually be connected to wireless networks. That's actually going to allow these products to get even smaller, lighter, and less costly. So, that really drives us to, hyperscale, volume of users and growth and getting into the actual metaverse. So those are things that we're focused on, is actually solving those types of problems as opposed to, using users as our product.
All right, Dan O'Brien, thank you so much for joining us. We'll be right back.
Welcome back, everyone. It's time for Cover Time. 3 stories, 1 minute each. We start with this. Elon Musk is looking to cut Twitter's costs on more than just rent. But it's janitorial staff and security services that just reportedly have been cut, leading some workers to rely on bringing their own toilet paper to the office, according to a new report from the New York Times. Look, I paused because, number one, this is bad for some of the janitorial staff. One such figure had been there for more than 10 years. So you talk about a staff that has been at the company, that has been, just down the roll for quite some time at Twitter, and as of right now is jobless because Elon Musk doesn't really want to have furniture there. He wants to just kind of erode or eradicate this whole culture that they had previously and just focus everybody on production. But that's not exciting.
I appreciate your serious take on this, but I'm going a hard turn, and this is unexpected. If you work at Twitter, you're practically sleeping in the office to rebuild this company, and now you're being asked to bring your own toilet paper, and then, oh yeah, you can't use the toilet paper because the toilet is overflowed in the bathroom, and there's nobody there to clean it up, so you can't even use the toilet paper. I mean, you have to connect the dots. This is just the reality of the situation. I can go on, but I won't because I'm just going to cut myself. All right, as COVID cases continue to cause concern in China, the U.S. CDC is reportedly considering using wastewater from international flights to track new emerging variants, according to Reuters. Wow, talk about a segment for there's little boys here, bro. I mean, this is just, I mean, I've never heard of this stuff before, but maybe it makes sense. I have no clue.
Well, there are other jurisdictions around the U.S. for sure that also track within their wastewater what the levels of COVID are. So it's really just implementing this across some of the travel mechanisms as well.
So when I went to the bathroom on my plane a month ago, I mean, that could have been tracked. Don't we have to get some disclosure or something?
Not on the plane, but if you're going here at the office and it goes into the New York City wastewater, the New York City Department of Sanitation, I believe,
but they don't know the wastewater is coming from, the 9th floor Yahoo Finance.
They can't say it's coming from you.
Yeah, they don't know it's from me.
No.
Yeah.
It's not on the blockchain.
Well, in that case, I'm happy to help. If we can prevent the spread of COVID through my wastewater, I'm all for it.
Why not?
Yeah.
All right. Good. Here's another story that we're tracking here on the day with about 4 seconds to spare in this other wastewater story. Let's talk about Warren Buffett fighting back against a proposed $300 million streetcar project in Omaha, Nebraska, despite a hole for the project already being dug into the ground. Buffett is instead encouraging the city to invest further in its bus system. I don't push back against the investment. I mean, why can't you have both investments? An investment in the bus system to make sure that people don't have transportation deserts, but then at the same time, I mean, I don't know what the streetcar racing is like in Omaha, but apparently it is so serious that he would push back against that and say, you know what, there's another way that we can do it.
I'm with my boy Warren Buffett on this one. I think streetcars are just outdated and just borderline on dumb. I mean, you having traffic run around the cities. And
you say that as a fan of American muscle cars.
I do. Streetcars, like they're subway cars. Yeah.
Oh,
yeah. So we have subway cars running around busy streets nowadays with cars racing, and you're having all these other high-powered cars out there. I'm with Warren. I don't want these things in there. I think they ultimately are only being put in to benefit one company, the Mutual of Omaha, which is opening a new $600 million headquarters there.
That's a good point. I misinterpreted the streetcar word.
Yes.
Yeah, street racing is where my mind went.
Fair enough. All right, coming up, stick with Brad and I for the next hour to wrap up this last day of trading for 2022, including a conversation with the president of MJP Wealth Advisors. You won't want to miss it. We'll be right back.
Welcome to Yahoo Finance. It is 11 a.m. on the East Coast, 8 a.m. on the West. I'm Brad Smith alongside Brian Sazi. Here's what we're watching for you today. Sea of red. The Nasdaq is down yet again, adding to this year's 30% drop, the worst year for equities since 2008. But consecutive yearly falls are rare. So the thinking is, next year we get an upswing, right? Well, we're going to ask a strategist later on in the show. Also, D.C. focus. We look at the tug of war over the next Speaker of the House as Congress prepares for its reshuffle. We'll also ask if inflation will dip below 3% in 2023. And movie magic. The latest Avatar may have crossed $300 million in domestic sales, but the U.S. box office isn't back to pre-pandemic levels just yet. We'll ask ComScore if 2023 is the year that we really get back to business. But first, let's check in on the major averages here in the U.S. The Dow, the S&P 500, and the Nasdaq all lower across the board. Dow down 0.7%. S&P 500 also under pressure. It's down by about 0.8%, and also under pressure to the tune of about 0.8% is the tech-heavy Nasdaq composite as well. Let's also just briefly check in on the Treasury market, see how things are moving there. There you're taking a look at the 5, 10, and 30-year yield. All of those are higher here today. 5-year is up by about 1.6% right now, Saz.
All right, inflation was one of the biggest political issues of the year, testing Biden's presidency and the Fed. But it's what happens in 2023 that will provide more clarity if 2022 ended well. Here to break it all down is Yahoo Finance senior columnist Rick Newman. Rick, take it away.
You know, I think as we round out 2022, I think the dominant story for President Biden is the rebound he enjoyed in the second half of the year. Biden ended up having a pretty good year. And if you just go back 6 months ago, guys, it looked terrible for Biden. Back in June, gas prices hit $5 a gallon, and the inflation rate peaked for the year at 9%. And Biden's approval rating right around the same time hit an all-time low for his presidency of around 37 or 38%. And then came a kind of a gradual Biden recovery. He got two big laws passed through Congress, which did not look at all inevitable. That would be the CHIPS Act and the Inflation Reduction Act, which is not about inflation, it's about green energy. But those have enjoyed generally pretty good support since then. There are no real lingering controversies over those two laws, the way there was, let's say, after Congress passed Obamacare in 2010. And then Democrats outperformed in the midterm elections. And meanwhile, we've seen inflation coming down. So it's possible as we round out 2022 that we are setting the stage for a pretty good 2023, especially if inflation continues on this gradual downward course, which could put it below 4% or even some forecasters think below 3% by 12 months from now. That would be great for Biden, but there's a lot that could go wrong in the meanwhile. So we'll see what happens. And one of the big questions, of course, is whether this recession that some people think is happening is actually going to materialize next year.
And Rick, another major story on the day, long awaited, Congress released former President Donald Trump's tax returns to the general public. What can you tell us there?
I'm deep in the middle of those tax returns right now. Nobody is going to draw any quick conclusions from these tax returns because they're very complex. They released returns for both Trump's businesses and his personal returns. Just to give you some idea, Trump's individual tax return for just for 2020 alone is 350 pages long. And he has many, many business entities. So it's going to be a long time before we kind of figure out what's really in here. But, you know, my first top line takeaway just from looking at the summary sheets for his business and personal tax returns, I think there's an obvious reason, at least one obvious reason, Trump did not want people to see his tax returns. And it's that he reports business losses almost every year without fail. So if you go back to 2015, when he first announced his candidacy, I mean, a big part of his campaign persona was he's this super successful businessman and we need a businessman in the White House. But if you look at his tax returns for his businesses, you'd say, if you're so successful, why are you losing so much money? And this has a lot to do with the way income is reported for real estate developers. And Trump has been able to carry forward big losses from prior years, which is why his tax bill is so low. But if you were just looking at the top line of Trump's tax returns on the business side, you would say this does not look like a successful businessman because somehow he loses money every year. somehow that's how he gets his tax bill low, and he's got other income streams that finance his gilded lifestyle. But on the surface, he has a lot of explaining to do about how he can be such a successful businessman if he loses so much money.
All right, some light reading material in those 350 pages. Yahoo Finance's Rick Newman. Thanks so much, Rick, for continuing to comb through.
Yep.
Let's shift now to the markets on the last trading day of the year. Investors heading into 2023 with a lot of food for thought. Here to discuss, we've got Brian Vendick, who is the MJP Wealth Advisors President. Great to have you here with us. If there's one big theme that you hope we leave behind in 2022, and perhaps one that prevails in 2023, what would that be from your purview?
Good morning, Brad. I don't know if we're going to move past the theme of what the Fed is going to do when we turn the page on 2022, but I still think that theme is still going to be the dominant tune in 2023, which is what's the Fed's view on inflation? Are they doing enough? Are they doing too much to fight inflation at the risk of driving the economy into a recession? And I think right now, most investors have more of a pessimistic view going into next year that the Fed is pushing too hard on the brakes with these interest rate increases and not taking into account the $1 trillion is going to be rolling off of their balance sheet over the next 12 months. So I think we get to the end of January, we'll start to hear Fed speech again about interest rates and outlooks. And when I look at the market estimates, it seems like most are expecting the Fed to change its tone or ease back on rates in the middle of the year next year, because there's a higher probability that's growing that the U.S. economy will be slowing and maybe we will have a formal recession declared. So I think in the short term, over the next couple of weeks and definitely throughout the Q1, you're going to hear the same story as before. Volatility in the marketplace, be concerned about multiple compression in high value stocks, and look for companies that can help us support free cash flow and dividend growth to kind of move through some of these uncertainties in the short term.
Brian, the stocks that have been beat up this year, and I'm looking right at big cap tech, do you buy those in January?
Brian, I still think it's a little bit too soon to talk about tech stocks. I think they are definitely attractive, especially some of the large mega cap tech stocks for sure. A lot of the problems and concerns and valuations have been priced in some of those, especially in the consumer discretionary space. But knowing the fact, and even look at the month of December as an example, when we saw interest rates tick up on the 10-year Treasury, we see the Nasdaq and tech stocks trade down. And I think that's the concern, because we still know that the Fed is going to increase rates somewhere between 50 to 75 basis points at least next year, and also still talk about the story of where we are with inflation in the labor market, which again causes issues from a valuation point of view. So I would still tilt clients' portfolios and still consider our audience to consider dividend payers, the energy sector that has a high free cash flow yield, and also looking at companies that are going to help to solve the European energy crisis, and also still think about maybe even financials and consumer staples, as a means of kind of working through this. So I still like tech from a longer term point of view, Brian, going back to your question, but still being a little bit cautious over the next 3 to 6 months.
When you speak to your own clients and the people who are asking you questions about what they paid the most attention to in 2022 that perhaps they don't need to in 2023, that's just really something that may be a sideshow. If I'm crafting my own investor New Year's resolution not to pay attention to one thing in the market, what would that be?
I would say let's stay away from things that feel like speculation. I think a lot of clients, heard about things that, seemed attractive, saw some historical numbers that ran up and were intrigued by those things, especially when you look at the declines of some of these assets from their 52-week highs to where they are now. I think moving forward, clients have digested this adjustment in valuation in the market and coming back to the reality that fundamentals do matter when it comes from an investing perspective. So focusing on things that can help to support income generation. We're getting more on cash. Short-term treasuries look attractive, short-term municipals, dividend payers, and again, Staying away from things that seem a little bit too good to be true, and let's focus on the fundamentals for the balance of the year.
Good words of wisdom. Brian Vendig, MJP Wealth Advisors President. Good to see you. Happy New Year.
Happy New Year.
We're watching Apple headed into the waning moments of 2022 trading. Shares of the tech giant fell below key support levels around $130 earlier in the week on fears of China's reopening. But Citi analyst Jim Suva told Yahoo Finance this week Apple remains a top pick at the investment bank, citing the potential for new AR VR glasses in 2023 and more stock buybacks. Coming up, DC Watch. Kevin McCarthy's path to House Speaker is on shaky ground. We'll have the latest on that and the next step in President Biden's battle with big tech. Now to Washington, D.C. ahead of what's sure to be a contentious year as the House changes hands. Fresh reporting from CNN suggesting House GOP leader Kevin McCarthy has offered a concession to critics in his bid for the speakership, this being a reduction in the threshold for a vote to oust the sitting speaker. Let's get to Yahoo Finance's Jen Schomburger for a breakdown of the situation. Jen.
Hey, good morning, Brian. With Republicans set to take over the House next week, the party is grappling with intra-party divisions that could stall their legislative agenda, showcasing that a handful of conservative Republicans are holding out on pledging votes needed for Kevin McCarthy to be the next Speaker of the House, setting up a clash right out of the gate when the new Congress convenes on Tuesday. Several House Republicans have withheld support for McCarthy in return for commitments on spending and legislative rules. In a concession to try and gain support, last week McCarthy agreed to demands the House should block bills from Republican senators who voted for the government funding bill this month, a commitment that will be difficult to keep, especially if McCarthy wants to work with the Senate to pass legislation. Kowtowing to different factions within the party, especially given a slim majority, will make it difficult for House Republicans to come together. While Kevin McCarthy is likely to be the next speaker, This fight is a preview of how tough it will likely be for Republicans to advance legislation over the next 2 years. That's why raising the debt ceiling is a worry next year. House Republicans are expected to use the nation's borrowing limit as leverage to push substantial spending cuts, setting up the potential for a standoff that could rattle markets. White House chief economist Jared Bernstein warned Republicans against using the debt ceiling as a negotiation tool next year, with the economy in transition facing the headwinds of rising interest rates and elevated inflation. Bernstein told Yahoo Finance in an interview last week, quote, "It is always an absolute awful time to fool around with the debt ceiling the way the Republicans have been talking about, but it's even worse now. We've been talking about an economy that's in transition, headwinds which are real. There are obviously risks of different landing scenarios. This is just the absolute worst moment to contemplate own goals." He went on to say weaponizing the debt ceiling to achieve spending goals is the height of irresponsibility. Of course, raising the debt ceiling is spending that Congress has already authorized. Meanwhile, McCarthy has pledged to keep an eye on spending on Ukraine, a concern for House Republicans, saying that they will not write a blank check to Ukraine. So while it was expected that there would be gridlock between parties next year, it appears there could also be gridlock within the Republican Party. Brian?
All right, I'll take it from here. Thanks so much. Yahoo Finance's own Jen Schonberger. Appreciate the report. Everyone's staying with D.C., but shifting focus just a little bit. It's been almost a year and a half since President Biden signed an executive order aimed at cracking down on big tech, part of his wider plan to promote competition in this space. His quote that capitalism without competition isn't capitalism, it's exploitation, still ringing in the ears of the biggest players in the space. So where are we now and what's in store for tech major cap companies in 2023? Let's get to Yahoo Finance's Dan Howley. Dan, what do we know?
Well, Brad, we were expecting to see something coming out of the spending bill, perhaps some kind of new legislation, but no such luck. We really didn't get anything as far as major changes from Congress this year. There's been large discussions about privacy legislation, whether or not there should be legislation improvements to how children's data is used online, but so far nothing. Really where we're seeing things kind of take shape is that the FTC, the Federal Trade Commission, is kind of cracking down on big tech in various ways. And, since Lena Khan came in, who heads up that commission, she's really kind of looking to put her stamp on things, especially when it comes to the antitrust matters. She's basically kind of made her name writing about Amazon and how that should be looked at potential antitrust issues. So some of the major things that she's working on right now are obviously the effort to break up Meta, split off Facebook, Instagram, WhatsApp from each other. There's that ongoing lawsuit. Then there's also her pushback against the Microsoft plan to purchase Activision Blizzard, that she basically says that would damage some of the competition in the video game space. Microsoft pushing back extremely hard on that. Obviously, Meta pushing back on its own issues with the FTC. We have the potential for a DOJ investigation going on into Apple, determining whether or not they're using or breaking antitrust laws. And then we also have, obviously, Google, parent Alphabet. They're dealing with their own antitrust issues from a variety of state attorneys general. So, we're still kind of in this holding pattern where we were expecting some kind of change perhaps this year, but nothing really came out of those congressional hearings that, essentially said that these companies were breaking antitrust law or there were potential violations of antitrust law. Where we're really starting to see kind of momentum in that place is overseas. We're seeing it with the EU, the UK, South Korea. We're seeing India looking into antitrust violations for these companies. So, as far as crackdowns here in the US, it seems to be slow going at this point.
Yahoo Finance tech editor Dan Howley, thanks so much. Coming up, as plant-based products take the market by storm, we'll look at the next big thing in the food industry with one VC investor. Stick around.
Welcome back to Yahoo Finance Live, everyone. Taking a quick look at the major averages here in the U.S. as we are almost 2 hours into today's trading session. The Dow Jones Industrial Average, you're seeing that lower by about 0.9%, 287 points to the downside right now. The S&P 500, you're also seeing that lower by about 0.9% right now. And then the tech-heavy average, the Nasdaq, that's down a little more than 1%. As of right now, the sector performance is pretty much down across the board. Really only one sector in positive territory, and it's kind of mirroring or analogous to what we had seen throughout most of the year. Energy is the only sector in positive territory, but you've got 10 out of 11 S&P 500 sectors in negative territory right now. Technology down 1.2%, materials also down 1.1%, and health down 1.1%. Those are your biggest decliners on a sector basis right now. So we'll keep a close eye on that as we move forward throughout the rest of today's trading session, the final one here in 2022. And one of the latest venture capital firms, New Fair Partners, who invests in early-stage food and beverage businesses, announced that it has raised $20 million to date in its inaugural fund round. For more, we welcome in Ellie Truesdell, New Fair Partners founder and managing partner, as well as Yahoo Finance's Brooke DePalma. Great to have you here in studio with us, and early Happy New Year to you as well, Ellie. And we're looking at some of the brands that you've invested in.
Already had one.
As well, already broke into one.
I love that. It's almost done. Amazing.
Made for the modern eater. I'm that guy.
It's a good space to be able to evaluate, because not only can you really check out the taste of some of the different investments, but you can also really get a profile of how they may fare even next year in a recession. What do you really use as your criteria to evaluate companies in this environment?
Sure. Well, first, thank you for having me. It's great. I love that you guys have already dived right in. I think we look at a lot of things, and one thing that we are actually pretty optimistic about is that when we at New Fair are looking at a new brand, we want to see true long-term value proposition. We talk a lot about the modern eater and a consumer who's expecting or demanding a lot more from their food. So much of our thesis and what we've built our fund on is based on my experience at Whole Foods after 10 years of spotting young brands, emerging up and coming startups, and recognizing that, the macro shift towards health and wellness is not going anywhere. So if a brand, what we're seeing is a brand really needs to be offering some sort of indispensable attribute to their consumer. Otherwise, they are going to be in a tough position during a recession.
And one thing that you invest heavily in, you say that you're driving the next generation of food now, including midday squares. Plant-based protein was really a key term that we heard a lot of in 2021. In 2022, we saw some companies scale back, and Beyond Meat perhaps getting poor attention for just not performing as well as previous years. Where do you see plant-based protein moving in the next couple of years?
Yeah, I think plant-based protein is a really interesting part of the market right now. We've seen a lot of fall off. Beyond Meat is getting a lot of hammering right now. But what's interesting is what we've always mentioned is that consumer trust is sort of number one when it comes to food, as is consumer brand. And a lot of these tech companies that went after growth growth at any cost, they maybe lost sight of that. And we get most excited about plant-based alternatives that are actually focusing on nutrition, they're focusing on health, they're focusing on attributes that the consumer actually went to them in the first place for, unlike a lot of the processed products out there that are seeing some of that sacrifice.
There's an evolution. I'm a bit of a snack bar freak. I love these convenience foods, and I know I love RX bars, but this right here seems to be an evolution of this, which has been out on the market for a couple of years now, I believe owned by Kellogg right now, RX Bar.
That's right.
What are some of the taste profiles that a lot of these new companies are focusing on the next year? What's that next big trend?
Yeah, this is an exciting one for me to talk about just because I had the chance to bring in RX Bar to Whole Foods years ago. And when I first met that team, I thought to myself, I'm not going to bring in another protein bar ever. It's like such a saturated market and category, but they were doing something really different. They had a really unique ingredient deck profile. Their brand was excellent. And Midday Squares was sort of that same aha moment. I tasted the product, I saw the brand, I saw what they were doing, and thought this is going to be the next big thing in protein bars. And when it comes to flavor profile, I think what's interesting is our RX Bar really focused on egg whites and using something that was novel, but they have sort of a chewy texture and maybe something that not every customer
They take a while to finish.
is going to go for. I've heard a lot of people need to drink a lot of water to get them down, whereas Midday Squares is a really unique self-manufactured product. It's 2 different textures. It sort of is gets your chocolate bar fix, gets your protein bar fix. It's a really exceptional product that we love.
And now something that's unique about New Fair Partners is you are a primarily female-led team. We don't see that too much in the VC space. When you view the space overall, you know, some stats to throw out there, 25.5% of female-founded companies get VC funding. You also see that even less of percentage of VC firms are led by women. What sort of responsibility do you feel to support women in VC as well as invest in these female-founded companies?
Yeah, you know, we're really proud to have been able to raise our fund this year. It was a tough fundraising environment, and obviously with those stats, it was sort of working against us. But I think my prediction and my hope is that this is just the beginning. I'm really hopeful that we're going to see more female-led funds, more female executives, more females on boards. I very often am the only female in a boardroom, and while that's really disappointing, what we're seeing, and actually what we really have based our fund on in being operators, is that companies are recognizing the value in having strategic capital and having operators on their boards, on their cap tables. And so the more that that happens, I think the more diversity we're going to see, both across gender, but race, age, and background of experience.
What do the valuations look like now after a tough year in markets for some of these upstart brands? And then what is the appetite for a Kellogg or a PepsiCo to go out and buy some of these companies next year?
Yeah, I mean, valuations are taking a hit, of course, as is everything. We focus on seed and Series A investments. They're a bit earlier stage, haven't seen quite as much of that hammering, but I think they're still experiencing it. And the market is just not there. There's a lot of apprehension around putting capital in, so everything's slowed down. That's probably the case for a period of time for strategics, but we're really optimistic. We think that the big players, they're threatened. You know, when I read about people trading to private label or store brand products, that means they're trading from Kraft Heinz to store brand. It doesn't mean they're trading from Midday Squares or a lot of these premium consumer brands that have really created a differentiated experience.
How has it also changed in terms of the valuation that you were just running through and discussing? How has it also changed the capital ask that some of these companies are coming to you with and pitching for?
Yeah, I mean, I think a lot of brands are resetting a little bit. They're really taking stock in their runway, how much money they need to raise. We're seeing a lot of extension of rounds or some down rounds, and founders, I think, being a little humbled by what they're experiencing for the first time. It's been such a boom market that they're just realizing, all right, let's look at the health of this business, let's look at long term, and let's raise what we need, even if it's at some harder terms for them.
All right, go ahead, Brooke.
Oh, I just wanted to ask one more. One of your senior advisors is Bobby Flay. You created, from what I understand, Made by Nacho with him, a pet food brand. Am I right? Do you expect to see more pet foods? I know we're hearing a lot about how there was a boom in adoption during COVID, back down a little bit.
Yeah, I think we're still very bullish on pet, of course. We made a really conscious choice and effort to focus on cat and cat only. So I was lucky to co-found the brand Made by Nacho with Bobby Flay in 2021. We've had a really strong and very high growth start. But what we recognize is that for every dollar invested in pet, 95 cents went to dog. So you don't want to make this comparison, but it's similar to some of the earlier stats we mentioned today, which is sort of funny. But cat is really this underinvested, under-focused market, and we just recognize there needed to be sort of that next generation modern cat brand. So we're really excited about premium cat in particular, but also think there's plenty of room for growth in pet. It's just an explosive category.
Fascinating stuff you are working on. Look forward to staying in touch. Ellie Truesdell, New Fair Partners founder and managing partner, along with our very own Brooke DePalma. Good to see you both this morning. All right, coming up, taking stock. Equities are closing out 2022 true to form. Yahoo Finance's Jared Blickery is here with 3 charts that say it all. Don't miss it.
2022 is going down as the worst year for stocks since the global financial crisis and the worst year for bonds going back to at least the 1970s. Yahoo Finance's Jared Blickery is here to break down the year in charts. Jared.
Yes, well, we were talking about bonds here. I thought, what better way to cap off the year than a history of negative yielding debt? Is that a head scratcher? No, because I am saying this is the close. This is the ending chapter on the free money era. Now, European debt went negative several years ago, back in 2013, 2014. And check this out. We peaked only a couple years ago during the global financial panic, but it only took a few years to get back down to zero. And that came with very aggressive hawkish monetary policy around the world. Guys.
Jared, hit us with another chart.
Well, here's another one. This has to do with the volatility of 2022, and this tracks the 2% days when the S&P 500 moves 2% or more. Now, we saw, I think, let's see, I don't have the index here. Anyway, we had slightly more days in 2022 than we did in 2020, but going back to the global financial crisis, we can see that was actually a much more volatile time. This is 2008, 2009, 2010, and so the volatility years, those tend to cluster. We also saw this around the dot-com boom. And what's striking here is the fact that we didn't really have many of these 2% days for a good portion of the history of the S&P 500. I think this is the new normal that has emerged with electronic trading over the last few years, guys.
Jared, while we have you, what were retail traders buying this year?
Good question. First of all, they were buying the S&P 500 Spider Trust. That's SPY. That's my Twitter handle, by the way, Spy Jared. But aside from that passive investment fund, Tesla was the highest purchased stock here, and we have that about $15 billion. After that, we got the Nasdaq 100 QQQ Trust, and then after that, Apple. So Tesla, Apple, AMD, Nvidia, Amazon, Microsoft. That's what the retail traders were buying this year. Not the biggest surprise, but I'll tell you what, I want to show you one more chart here. This is the number of trading and puts and calls that has surged over the past 5 years. Since the pandemic and all the stimulus that we saw in 2020, 2021, guess what? Retail options trading has exploded and it's changed the market. It looks like this is the new norm. So this is something we're going to track going forward. The retail trader has definitely changed the very structure of the market, guys.
Best believe they have. Jared Blickery, thanks so much. All right, 2023 is shaping up to be a much better year for the box office with the likes of Creed 3 set to debut. I'm very excited about that one. Let's check in with ComScore senior media analyst Paul Dergarabedian. Paul, good to see you here. Your biggest takeaway from really what has been a challenging year for the box office this year?
It really has. It's been so interesting. I mean, I've been doing this for 30 years, and this is the most confounding, interesting, and kind of fun year to analyze. So it's been a real roller coaster ride. I mean, we started off in January with Spider-Man No Way Home that led that month. It actually opened in December of last year. But this year, Top Gun, it's all about Top Gun and, of course, Avatar right now. But Top Gun was the movie that signified to the world that the movie theater was the best place to view filmed entertainment. And that, I think, was a turning point for theaters because so many of the films that had come out over the past few months in the first part of 2022, the box office was moving in fits and starts. So you had various movies dominating an entire month, like Spider-Man, The Batman, Uncharted. It really wasn't until we got to this summer when Doctor Strange kicked off the summer movie season in grand fashion with a $184 million opening weekend that we felt like, wow, we're going to have a great year. And we did have a great summer, and Top Gun was in the mix there. Minions, The Rise of Gru. There were so many big films in the summer. But then in the post-summer period, things really slowed down. And it would be weeks where one movie would dominate. Black Panther, Wakanda Forever was #1 for 5 weekends in a row until, of course, Avatar, The Way of Water opened, which, by the way, has now eclipsed the $1 billion mark at the global box office.
If there's anything that you can extrapolate from previous recessions and movie-going habits or content consumption, what would you apply towards 2023 and the release schedule that we know of, at least right now, as it relates to what's going to come out, the movie theaters that can be impacted, the amount at which some end users are comfortable spending for that streaming and that content or that movie-going experience?
Yeah, well, there's a lot to unpack there for sure. But the good news is for 2023 is that there's more movies more often. The issue with 2022 is that we are going to wind up with about 40, count them, 40 fewer wide release films. If each one of those, let's say, made $40 or $50 million, we wouldn't be looking at a $7.5 billion year projected by ComScore for 2022, but closer to $9.5 billion year. But 2023 has so many great movies on tap. You mentioned Creed 3. We've got Indiana Jones 5, Mission Impossible, Dead Reckoning. I mean, it's just the hits just keep on coming, but they're coming more uniformly on the calendar, and there's more of them. Movie theaters are a momentum business. And if you don't have that momentum and the wind goes out of the sails, which happened many times over 2022, it takes a while for the business to build up a head of steam, but some great movies on the way. Of course, yes, the expense of going to a movie theater, that's a big buy-in of time and money, although it's a bargain for what you get, in my opinion. But yeah, certainly consumers have more choices today than ever before on more platforms. And that just means that the competition is greater. But with the lineup of films we're seeing next year, I think people are going to find that income in their pocket to go to a movie and go along for a ride with Indiana Jones for a couple of hours for, 10 or, well, in some cases, a $20 ticket for a premium large format. But I think that's a pretty good bargain.
Paul, I only got about 30 seconds here, but at ComScore, you also leverage some of the data that you're able to take in and actually publish that or make that available to marketers and advertisers. We're seeing a pullback in some of the dollars spent from advertisers given the cost restructuring that's taking place at companies right now. And so with that, have you seen a material shift in where advertisers are putting their dollars?
Absolutely. And I think, too, especially for the movies side, having marketing dollars put towards that is very important. But if that money is being spent elsewhere and not as heavily vested in the movie side, meaning theatrical films, that can be a tough go. But the movies, I think, next year are big enough that the mere mention of the brand of them will get people to go to the theater. There's a ton of franchise films next year, and that's actually good for the business, even though we don't want to lose sight of the fact that independent film is very important and that people should support those films. A movie like Babylon that's out there right now, The Whale, those are great films, but it's going to be those big Marvel films, the John Wick 4s, the Mission Impossible films that I think are really going to get people out there. But Ant-Man is the one that's really going to kick off the box office year of 2023 on February 17 when that film's open. So I'm super excited for 2023. I think we definitely hit the $9 billion threshold for the full year box office.
All right, Paul, that was a little more than 30 seconds, but I like your Lego set in the background because I have the same one, so we'll let you slide today.
Awesome.
ComScore Senior Media Analyst Paul Dergarabedian joining us. Happy Thanksgiving.
Happy New Year.
Happy New Year to you. Happy to everyone. Happy holidays. Yeah. Coming up, everyone, contrarian indicators. Our next guest says demand for champagne is at an all-time high. You got to stop laughing so I can stop. So maybe we're not heading into a recession. We break it down next.
Happy. Bring on the paper hats, the buckets, and the bubbly. It's New Year's, and if you're looking for the finest fizz out there, it helps to live in these few states. All this according to Finance Buzz. California is seeing the average price for a bottle at $46.55, despite having the highest population in the country. Florida, meanwhile, seeing champagne hit $44.98 per bottle. And topping the list, Texas, where a bottle costs a measly $43.88.
In the spirit of New Year's, our next guest says that demand for champagne is at an all-time high. Let's bring in Allison Napias, who is the senior editor and tasting director at Wine Spectator magazine. Perhaps my next career. Thanks so much for joining us here today. Very exciting to have you on. Very festive occasion, of course. Many people looking to where they should get their champagne and perhaps do it at a reasonable price. What tips do you have?
Well, I mean, I think the first thing to say is that, yes, champagne is at an all-time high. So finding champagne at an affordable price, I was actually surprised by some of those averages. You're going to have to shop around a little bit, but I think if you do that, if you look at your local retailers, look online, you can certainly still find a good value in champagne. And of course, if you're somebody who wants to splurge, we've got bottles for that too.
Allison, it appears that you are surrounded by various forms of bubbly or wine. I apologize in advance if I got that wrong. What is the most expensive bottle in front of you, and why does it cost so much?
This is Dom Perignon, $250 a bottle. So I gave this 96 points. It's a 2013, which is actually their current release. And part of that really goes into the cost of it. Champagne, part of the reason it's so expensive is that even a non-vintage, the most introductory version starts, it's aged for at least 18 months, very often more times 3 or 4 years. And then when you're talking about vintage bottles like this Dom Perignon, you're looking at 10 years, sometimes many more years than that, 10 or 15 before release. So it's part of the complexity of the wine, and the winemakers are basically aging it perfectly for you. And of course, that's holding on to inventory, and that raises the price slightly.
Allison, a way to make me look bad. I picked up some $18 Corbel last night for our production team after the show here today. So I clearly I should have picked it up. Brad, take it away.
That's what we have to look forward to?
Yeah, I know. That's all I got. I mean, the bottle was really nice, though.
Still going to be good.
All right.
Allison, when we think about the number of people who are perhaps trading down their size at Costco.
Oh, that guy.
There are a lot of people that are trading down in this environment and perhaps opting for different types of bubbly or even different beverages all in. What have you seen thus far? And if people are going to trade down, what would you recommend trading to?
Well, I mean, we covered champagne in our December 15th issue here and in our episode 3 podcast, which you can listen to at winespectator.com, because that's kind of the luxury item for sparkling wine. However, there's a lot of other options out there. Prosecco continues to be very strong in the U.S. And that's also what kind of taught wine drinkers to enjoy sparkling wine on a more everyday basis, or more regularly, I should say. Cava, for sparkling wine from Spain, is also doing very well. And those are both two regions where you can find things priced probably in the $15 to $25 range very easily. Same thing with a number of domestic sparklers from California, from Oregon. So there are a lot of options out there if you don't want to go for the big splurge on a bottle of high-end champagne.
Yeah, that big bottle that I was just holding, that was from Costco, Allison, $1,000, almost $2,000 bottle of wine. What Costco sells is absolutely amazing. But before we let you go, our team is really fascinated about this canned wine trend. Why is drinking wine out of a can such a thing right now?
Well, I mean, I think that's also part of the reason that maybe things are shifting in the wine market a little bit. We see, everyone knows about hard seltzers, and that was a big trend in the last probably five to 10 years. And so now a lot of winemakers are saying, hey, we can do that too. We can put it in a can. It doesn't have to be in a bottle. We actually had a canned wine for the first time on Wine Spectator's Top 100 Wines of the Year from Companion Wine Company. So they are on the rise in terms of popularity and in terms of quality.
Real cool insight here. Allison Napias, senior editor and tasting director at Wine Spectator magazine. Happy New Year. Thanks so much.
Happy New Year. Thank you.
All right, coming up, we're getting into some New Year's Eve food traditions next, the ones you know and love, and some you have probably never even heard of. Stay tuned.
New Year's Eve is filled with traditions, but inflation is taking a toll here in the U.S., and Brooke DePalma is here with some global traditions that will cost Americans more this year.
That's right. Well, first, let's kick it off with fruit. By the way, Brian, you look fantastic.
Thanks so much.
Kicking it off with fruit here, a Filipino tradition is to have 12 to 13 round fruit on the table. That's supposed to intend, of course, 12 months in a year, bring in prosperity. And then, as Brian, you have right there.
These are the biggest grapes I've ever seen in my life.
Grapes from the
These
West Side Market in Lower East
baseballs.
Side, Manhattan. 2 pounds of grapes cost me roughly $12. Now, that's an Italian and Spanish tradition to have 12 grapes at the stroke of midnight in order to represent each month and ultimately bring good fortune in the new year. Now, across the table, we actually have a Greek tradition. That is a cake called the Vasilopita. There is 1 golden lira inside that cake, and whoever gets it is brought good fortune. There's a golden lira inside the cake. So 1 coin inside the cake, and whoever gets it, it's meant to bring good fortune. Now they're pushing out of the way for each other. But we got that from Pie Bakery in Soho here in New York, and they told us that the ingredients to make the food ultimately cost about 25% more than this time last year across the board. And as you can see there, the reason why year over year, flour, cake, cookies, eggs, milk, butter, sugar, overall higher across the board. So certainly taking a toll on that Greek tradition. And now, Brian, some Americans like you like to create their own New Year's Eve traditions. And so Brian insisted on getting Taco Bell. Taco Bell is open at some locations on New Year's Eve and New Year's Day. Prices there up about 14.6%. You can see right here, we have a Crunchwrap on set. Now that actually is down from last year. The cost is down about $1.22. It costs roughly $2.42 now here in the US according to a study from Price Listo. So I know that you guys are
let's hit that ticker. Of course, Taco Bell owned by Yum Brands. Let's get this video clip on the Yum Brands on the Yum Brands ticker page. Bro, what the heck is this thing?
I believe that is a small lime. Don't need. But of course, you cannot have New Year's Eve without champagne. Champagne also higher alcohol at home, costing about 4.5% more. Now, according to Finance Buzz, the average cost for a bottle is about $55 to $56 on average. So certainly across the board, no matter how you celebrate New Year's Eve, it will likely cost you more this year. On a very serious note, gentlemen.
I mean, you sucked down 12 Bud Lights over there by some folks on our team. I mean, you're going to Taco Bell all day. You're going to Taco Bell all day, Brad.
Yeah, you got the Corbell here, too, to wash it all down.
$18 Corbell.
18. Yep.
Now, of course, as we just heard, though, consumers may be spending a little less on their champagne celebrations, opting for a different, maybe Prosecco, perhaps, as opposed to the more expensive champagne. But overall, these traditions costing a little bit more.
Wow. And eggs.
I feel so bad for you, Brooke. Every time
you always put me through this.
These have been some challenging food hits for you, but I'm so excited.
That's right. We did have a Crunchwrap Supreme that actually had an egg inside of it, and eggs up nearly 50% year over year. That's on top there.
Oh, that's on top. Okay.
And so certainly, when you think about just how much it costs to make that item, costing more for Taco Bell's bottom line, ultimately Yum Brands' bottom line, but also smaller businesses, as you can see with Pie Bakery, also feeling the brunt, and consumers at home perhaps getting these fruits.
Well, I don't want to be that guy that just puts my hand in this cake. I want the golden lira, bro.
No,
I can't do it because we have to eat the cake after this. Now I'm that dope who did that. I can't do it.
Yeah. Well, the egg doesn't travel well.
No, really? No. Well, where'd you find the egg one?
It's on the top.
It's on top.
Oh, wow. I didn't get the egg one. Thanks so much. I appreciate it.
All right. That's it for now, everyone. I'm Brad Smith here with Brian Sosny. That's Brooke DePalma. And from all the Yahoo Finance Morning team, have a wonderful, safe, and happy new year. Here's to a great 2023. Oh, yeah.
Let's go markets.
Nice.
Cheers.